inflation
Grab
remains
your
a bigger
phone.
threat.
Guy,
Hit
appreciate the
record.
update, buddy. As
And
always,
let
Guy
your
Johnson
idea
out of
fly.
London, Sterling, pulling back just a
The
touch.
future
Still
of
positive
your
at 6%,
startup
but
could
off
be
a
just
2%
one
rise
video
against the
away.
US dollar cable down to about
Remember,
126.
be clear,
Dovish
be
dissent at the Bank of
passionate,
England.
and most
Hawkish
importantly,
dissent at the Federal
be you.
Reserve. To Guy's point.
We can't wait to
One
see what
thing
you've
we
got.
know going into
Let's get
2025,
funded now.
Maximum uncertainty.
That's the reason why we're foggy. We are in a dark room with lots of furniture, as Jay Powell said. We are entering into the abyss of the unknown. A key question is, how much can central bankers get ahead of this? How much are they susceptible to this unknown? Do they have any type of scenario analysis or tests to really look out? And has the equity market fully wrapped its head around the uncertainty that's being reflected in some of these tortured decisions we're seeing from central banks?
Can I torture the analogy just a little bit more and extend it?
Please.
It's not just that the room has got darker. It's not that it's full of furniture. They don't know what room they're in. And that's the big problem right now for this FOMC.
Yeah, they don't know if they're in the kitchen.
No.
They don't know if they're in the bedroom.
Or if they're in someone else's house. They've got absolutely no idea where they are, Bramo.
I need to wrap my head around this.
Seen this multiple times in 2024. Might see it again in 2025. We begin this hour stateside with stocks steady after the Fed struck a blow to this year's rally. The S&P 500 posting its worst session since August, the worst Fed day since September 2001. And the Nasdaq seeing its biggest daily drop in some 5 months. Savita Subramanian with Bank of America staying bullish into New Year. Getting ready for a cyclical inferno. We target 6666 of the S&P 500 by year-end 2025. With cyclicals leading the way, we see more opportunities in stocks than the index. Savita joins us now for more. Savita, good morning.
Good morning.
So much to get through. Let's start with the outlook for next year.
Indeed.
What underpins that? And have you made any assumptions about the changes we could see from the incoming administration?
Well, look, we're not assuming anything about the Fed. We're not assuming anything about, kind of major changes in policy. I think what we're assuming is we see a little bit more of the same. And what that is, kind of a big reshoring effort that's already underway. We're seeing signs of a pickup in inflation. Again, we've been writing about how if we're in an environment that's similar to 2022, what do you want to own, right? Let's say real rates surprise to the upside, which is so far a little bit of the story, right? We've got inflation not completely back in the bottle. We've got potentially, higher nominal growth expectations next year. I think in that environment, you don't want to be in small caps, and I think there's a good reason that small caps sold off yesterday. You want to be in companies that generate free cash flow because short rates are going to remain higher than expected, and you want to be in companies that are more, let's call it inflation protected. So they participate in inflation rather than get hurt by inflation. And that would be, a big cohort of the S&P 500. Cyclicals, some big cap tech companies are well positioned for that environment. I think 2022 was a worse year for stocks overall because we weren't even positioned for the Fed to actually hike interest rates as demonstrably. Think about where we are today. I mean, we're actually in a much better place than we were a couple of years ago, right? The Fed has done a lot of work getting us off of ground zero. We've got latitude to ease our way out of the next soft patch. So, I kind of feel like this is a moment where maybe the Fed disappoints in terms of how easy they are. Maybe other central banks disappoint. But the S&P 500 can handle it, and there are parts of the market that can actually do well in that environment.
The larger takeaway from yesterday to me is the lack of certainty, and I think he's in the workshop that's dark with lots of workbenches around, exactly. And so it can be a little bit more perilous, and it also is a time of construction, and construction takes investment. Do you like how I'm taking this on?
Nice, keep going.
Thank you, I'm going to keep going. So you have to wonder if companies have the confidence to make investments in their workshops in order to really expand their businesses at a time of maximal uncertainty where policy members don't have a framework to even look at where we are.
Yeah, I mean, I think that was the story of the second half of this year. And we actually saw a meaningful pause in CapEx and planning because of just this binary outcome in the upcoming election. At least we have a result of the election. I would argue we're at a point of potentially more certainty than we were in late October. We have a result. We know who's in charge for the next couple of years. We have some sense of what's going to happen. We know that there's tariff risks, but there's also potential for, becoming an energy exporter again, exporting LNGs. So I think the big surprise next year, folks are expecting stagflation, terrible growth, high inflation. that's a tail event. In fact, what I find interesting is that fund managers, professional money managers, are basically assigning a 50% probability to stagflation. Stagflation barely ever happens. I think there's a better chance of an upside surprise to growth. Think about corporates. Corporates navigate different policies quite ably. We had a period of time where the Fed hiked demonstrably. We had inflation go from negative to 9 to 3, and margins were amazingly intact. So I think that this speaks to companies refocusing on efficiency, on productivity. They're still doing it. They'll get through this. Valuations are high for certain parts of the market, but not necessarily for the average stock. So I think this is an environment where things are going to be okay.
I'm looking at the sectors that you like: financials, discretionary, real estate. Some of these have gotten bid up in the immediate post-election response, and a lot of it was predicated on the idea of rates going lower. Was predicated on the idea that there would be a friendly Fed to cutting rates and potentially an equity market that would continue to go up.
Yeah.
If we don't get those two things, how much does that undermine the argument for these sectors?
I think that consumer discretionary is potentially most at risk of a more hawkish Fed. But when I look at other sectors, when I look at large cap financials, I mean, if we have a steepening yield curve, let's say the short end pauses and the long end continues to rise, which is kind of what we saw, I guess, over the last couple of months. In that environment, I think financials do well. Large cap financials, I mean, let's think about what this administration means. Deregulation is probably on the top of the list, and I think that's one of the positives for financials. And then when you think about just AI, generative AI, and what it can do for cost control in some of these more, kind of professional services industries, I think that is profound for margins. So I don't think the bull cases have gone away. For some sectors, like sectors that are geared to short rates coming down, like maybe more in consumer discretionary, that might be a risk. But again, when you look at the consumer, we're ably employed. Real wage growth is positive. We've got an administration in place that's probably going to lower the cost of energy, which helps that lower income consumer, which is the one area that's really starting to fray. I think it's going to be okay. I think that's the tail risk that nobody's talking about, is that it's actually going to be okay.
You mentioned employment. Can I jump in?
Yes, please.
I remember a note that you put out a few years ago about the labour intensity of the S&P 500. I'm sure you remember the note as well.
I do.
There are some questions about the supply side of the labour market under the incoming administration. How do you think about that with regards to the parts of the equity market you want to own, the parts of the equity market you might want to avoid?
Yeah, so let's say we get tighter immigration, let's say we get a shorter supply of labor, and that hikes up wages. I think it's a manageable risk because we've already been working in the context of demographics really eating up the workforce. So here we are today. We could see wage inflation increase in certain pockets. I think it's most acute for restaurants, construction, food services, agriculture. Those are areas where you could see a tighter labor force. But think about what those areas are doing. They're focused on efficiency. If you look at restaurants, we've seen the labor to sales ratio demonstrably decline over the last 2 or 3 years. Go into a restaurant, there's less people working and more processes. So I think that's the offset to a potentially tighter labor market. I don't know how you build a house with AI, so that's one area where you could see some problems. There are areas where this will be a margin squeeze, but I don't think it's as broad spread as one might expect.
Things are going to be okay.
Things are going to be
But the number you chose
okay.
was 6666. I mean, people get spooked by that.
I have to explain that. That was basically the idea that we're going from 666 at the market lows. Just tack on another 6. This is a pretty amazing ascent.
What a run it's been. Savita, it's good to see you. It's
Nice.
good to see you. And the run is set to continue, according to the team over at Bank of America. Savita Subramaniam of Bank of America, things are going to be okay. Equity futures doing okay, up by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Shares of homebuilder Lennar are falling in the pre-market, down more than 10%. The company forecasting new orders for the first quarter that missed analyst estimates. Lennar also announcing plans to spin off most of its land holdings into a separate public company. It plans to seek real estate investment trust status for the new company as it aims to shift to an asset-light construction model. Meanwhile, the International Brotherhood of Teamsters announcing thousands of Amazon warehouse employees and contract drivers in 4 states will walk off the job this morning right ahead of the holiday delivery rush. Workers in New York, Illinois, California, and Georgia will strike after the Teamster Union accused Amazon of failing to come to the bargaining table to negotiate contracts. An Amazon spokesperson said in a statement last night that the Teamsters have intentionally misled the public about union efforts at the company. And a change is coming to postseason college football. The New York Times reporting the presidents of the country's 8 Ivy League schools announced they will allow their teams to compete in the football championship subdivision's 2014 playoff. Since the conference was formed in 1954, Ivy League football seasons have come to an end on the Saturday before Thanksgiving to allow athletes to focus on their schoolwork. Not anymore. That's your Bloomberg Brief. John?
Yara, thank you.
Yeah.
You know, like,
I got nothing.
anyone outside of Ivy League care about that? Like, to me, it's like, I'm not going to offend some people, like, to me, SEC football, and then there's like, nothing counts.
Yeah, but there are a bunch of people who are very interested, and for you, I think that
But
that's
I'm
wonderful.
a tourist,
You're
and I
welcome.
probably offended a lot of people in the Midwest of this country.
So please, message him.
Don't do that. Up next on the program, Trump starting a fight on Capitol Hill.
We're going to have to find ways to find savings. Deficit hawks are gone in Washington. They don't exist anymore. And maybe you need the markets to send us a signal. It's time to become more sober in our fiscal outlook.
That conversation up next. Live from New York City. You're watching Bloomberg TV.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Equities on the S&P 500 bouncing back here. We're higher. This session high is actually up by 0.6% on the S&P. Bond yields are up too by another basis point or two. That trend continues. Yields keep climbing at the long end of the curve on a 10-year and on a 30-year. The 10-year maturity, 452.81. Under surveillance this morning, Trump starting a fight on Capitol Hill.
We're going to have to find ways to find savings. Deficit hawks are gone in Washington. They don't exist anymore. And maybe you need the markets to send us a signal. It's time to become more sober in our fiscal outlook. There's enormous optimism about the U.S. The economic leaders that have been put in place, the personnel's policy, have really buoyed that outlook. But ultimately, how will these different policies be put in place?
So here's the latest this morning. President-elect Donald Trump opposing a proposed government funding bill and threatening to oust Republicans who accept the legislation. This just days before funding is set to expire, raising the likelihood of a government shutdown. I'm pleased to say that up from the nation's capital here in New York City, Bloomberg's Mike Shepard joins us now for more. Shep, good to see you.
Great to see you.
Can we start with the basics? And you're the perfect guy to do the clinic. A continuing resolution. Tell me what one is and what that is that they're trying to pass down in D.C.
So it's essentially the same thing. They are trying to pass what's known otherwise as a stopgap spending bill. This would tide them over for a couple more months so that they can negotiate a little bit further. The funding authority for the fiscal year was supposed to have begun on October 1st, and they should have well before passed this legislation, gotten it done by September 30th. They ran up against that deadline, so they passed the temporary bill. That expires at midnight on Friday. So now they have to do another one, and the idea with this bill is that it would tide us over until mid-March.
So what makes it so controversial if you imply it's business as usual?
Well, it's not so controversial except to the president-elect and to some of his closest advisors, including Elon Musk, who is leading this Department of Government Efficiency initiative that's aimed at slashing the size of government, slashing government spending, and they together took aim at this bill yesterday on X, and then the president-elect followed up with Vice President-elect J.D. Vance saying, we don't like this bill in its current form. Republicans should reject it. Now, keep in mind, they have spent weeks, if not months, negotiating this, and they have been really on track to pass it in time to avoid a shutdown that would take effect early Saturday morning. So this is more than just a monkey wrench into the process. It really derails it altogether, and they have to go back to square one.
It was more than 1,000 pages. Mike Johnson spearheaded this. He pulled this together. How much does this imperil his leadership at a time where he got everybody together just days ahead of the deadline and bam, thrown out?
Well, it's not great, Lisa. And we talked to Ralph Norman last night for Balance of Power, and he is one of the conservative Republicans whose vote Johnson would need to be able to regain the speakership when they hold new elections for leadership when the new Congress is seated in early January, on January 3rd. And those kinds of doubts are being fueled even further by this move by Trump and by Musk. Who is calling the shots in Congress? Is Donald Trump putting the arm on Johnson in a way that undermines his authority with lawmakers? And it makes it complicated for him to then go back to members and say, hey, you know that deal we just negotiated? I'm really sorry. We have to unravel the whole thing now at the last second because the president told us so.
What struck me is it's one thing to have these grand proclamations about efficiency and getting things under control. It's another thing to work within the confines of a complicated system and an existing behemoth that is needing to chug along in order for people to get the services and be employed at the places they are. At what point does this create a certain level of dysfunction that some people in Washington, D.C. are concerned about, whether it means government shutdowns, whether it means potential confusion over certain funding for specific programs?
Well, Lisa, you hit the nail on the head. This really actually accentuates the dysfunction that they are saying that they would want to try to undo or reverse. For example, the spending bill, more than 1,000 pages, it does provide a lot of critical services and funding for initiatives that a lot of Americans would agree are necessary. For example, the package also includes, in addition to agency operations being extended that would keep the government open, it also includes disaster relief, it includes aid for farmers, and a lot of people out there in the public would also want to see that get through. And that is being imperiled by what we're seeing in the process right now, a process that has been unraveled by the intervention of the president-elect. Remember, he's not even president yet, but as the de facto head of the Republican Party, the incoming commander-in-chief of the largest economy in the world, his word does carry some weight. And he's also making some threats to Republicans who decide to cross him and continue to vote for this package or support this package, and do so by funding opposition to them in primary elections 2 years from now.
This might be a silly question, but where is Joe Biden?
Well, Very good question, actually, because he is still president of the United States. His signature on spending legislation is valid.
The fact we even need to sit here and say that.
Yeah.
How different is this transition to transitions before?
Well, it's in a way it is different in a sense because we see Donald Trump really inserting himself onto the world stage and onto the stage in Washington in ways that incoming presidents haven't before. He does bring the benefit of knowledge, having served as president for 4 years previously. But in this case, I think the Democrats are looking at this dysfunction and maybe sitting back and watching. We saw Hakeem Jeffries yesterday put out a statement. Look, we have a deal with Republicans on spending. We have the bill text. We expect the party and Congress to abide by it and then put the onus back on Trump and Musk and the Republicans in Congress to actually get done what they had agreed to.
Shep, it's great to see you and good to have you in New York. Thank you, sir. Mike Shepard there of Bloomberg on the latest. If the honeymoon was ever started, it's over for the likes of Speaker Johnson. It really is over. And I have to say this, business as usual in Washington, D.C. is controversial to Mar-a-Lago, and they're trying to change it.
This is true. However, trying to change it by torpedoing a bill would mean that if they can't get anything together and Mike Johnson can't really gain any sort of consensus, then you get a government shutdown, and that could lead to higher yields, and that could lead to this idea of greater uncertainty. I mean, you have to wonder at what point this filters into some ramifications that Mar-a-Lago would not be happy to see.
Got higher stocks this morning. Stocks up by 0.75% on the S&P. There's the bounce you might have been looking for, waking up this morning after the biggest one-day loss on the S&P since August, following yesterday's Federal Reserve meeting. Coming up, we'll catch up with the former Kansas City Fed President Esther George as the FOMC signals a stronger focus on inflation. Live from New York City, you're watching Bloomberg TV.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Some relief here. We've bounced back. Session highs up by, let's call it 0.7% on the S&P 500. This is what Peter Cheer, though, wrote after that Federal Reserve meeting yesterday. Positioning has been so aggressively bullish on stocks that it might be easy for the Grinch to steal the Santa rally. Lisa, you've said this repeatedly this morning, and I think you're right to point this out. We've compromised the easing bias at the Federal Reserve. I don't know if that puts the Fed put into question completely, but certainly we've made a move in the last month.
And that's one of the underpinnings of what some people call froth, the rally. And nonetheless, I have a couple of questions on a bigger level. First, is this the capitulation that people needed to see before they go back in, which is what you're seeing this morning? And how much really is skewed by the fact that it's pretty low liquidity? A lot of people don't want to be here today. A lot of people have already gone on vacation. Is that part of some of the big swings that we've seen as well?
A lot. Do you want to translate
No.
who a lot of people are?
No, I don't. Carry on.
Okay, don't. All right. 2 hours away from the opening bell. Let's get you some morning movers with Manus Cranny. Hey, Manus.
Jonathan, I'm still here. The Grinch arrived for Micron when it comes to understanding what's going on in the chip market. This is the personification of a miss, $1 billion miss for the second quarter through to February. So they're going to deliver $7.9 billion. The theory is that the AI chips part of the business is going to save them into the second half of next year. That's a bit like waiting for Godot. The PC market will grow by 5%, be rest assured on that. But this is a miss of about 12% on weaker smartphone, weaker PCs, and weaker autos. That's you, me, Lisa. Smartphone, autos, and PCs. I still don't have a car. But anyway, the data center business did grow by 400%, but it's not enough to invoke any upside in that this morning. Let's roll it forward and have a look at Lennar. Now, the house builders took a pretty bruising day yesterday overall in the market. Lennar is down 9.55%. Yes, there's supply constraint. Yes, we have demand. But affordability is limited from higher interest rates. There you go. And we may be going into an extended pause. Adam Posen told me that this morning. If not, into a hiking cycle. Margins, we can't give you guidance for the back end of next year. They're going to be around 19 to 19.25, but they cannot guide for the full year ahead. I'll leave you with a snapshot of Tesla. Yes, they've bounced back. Yes, yesterday was a pretty brutal day for them, up 3.8% this morning. But in Europe, their registrations fell by 41%. This is a company that promised you 500,000 cars in the quarter. They've never delivered 500,000 cars in any quarter. So that's just a little bit under the hood of what's going on with Tesla. By the way, you know, registrations of electric vehicles in Europe is down 10%. But Tesla, down 41% on registrations. Jonathan.
Hey, Manus, appreciate it. Tesla this morning up by 3%, getting hammered after that Federal Reserve decision yesterday, though still this month up big time. Under surveillance this morning, House Majority Leader Steve Scalise saying the latest stopgap funding measure is dead and a new deal is yet to be reached. This is President-elect Donald Trump says he wants GOP lawmakers to include a debt ceiling increase in whatever package they advance. I want to continue the conversation we had a little bit earlier on this hour, described by people inside Washington as business as usual. And when you get them to really tell you what business as usual actually is, and you hear it, that is why people are so annoyed with Washington, D.C., because this, to me, to you, doesn't sound like business as usual at all.
Well, business as usual consisted of Mike Johnson adding, at the last moment, an additional $10 billion of aid for farmers. And then in return, others, in particular, Democrats, were saying you need to have the control of the RFK Stadium in a certain district transferred to Washington, D.C. You need to have a pay raise for members of Congress. You need to also have another round of federal fundings for the bridge in Baltimore. Look, you could make an argument for any one of these potential issues. The point being is that what are we actually trying to do, and how do we do that in the most direct way possible? That is not business as usual in Washington, D.C.
This is not what a lot of people voted for. They voted for a change, which is why their so-called business as usual is controversial, which is why the incoming administration wants to do something about it. And you and I both said this in the previous hour. This is a huge problem. And it's going to be a really big challenge for the incoming administration to do anything about it. There is an addiction to doing these things in Washington, D.C. They just believe it's normal. And then they all get on board and have their own pet projects because they want to secure their own political future and stay in office. And that's not what the people of this country want at the moment.
And a lot of it is because there's not necessarily the appetite to have real debates or real issues which are exposed when there isn't a whole lot of hair around different bills. And that's essentially the business as usual that they're going to try to grapple with. It's going to be an interesting year.
More on that story throughout this morning. Let's turn to this one. The Supreme Court says it will expedite hearing TikTok's challenge to a law that would ban it in the US next month. The court scheduling arguments for January 10th, a little over a week before the ban is set to begin on January 19th. So that's quite a start to 2025 for that company.
Especially since the day after that is the inauguration for Donald Trump. So where will he fall in this, given the fact that he has seemed more amenable to the idea of TikTok remaining in operation in the United States of late?
Another controversial corporate story as well that we need to squeeze in. Reuters reporting that Nippon Steel $14.9 billion takeover bid for US Steel is all but dead. A letter reportedly written by the Committee on Foreign Investment in the United States setting the stage for President Biden to block the deal. CFIUS has until Monday to approve the deal, extend its review, or recommend that the president should kill it.
On a larger level, I just hope that we can get under grips what it means to have national security concerns and really get that under control, because there are some real national security concerns. And right now, I don't have a clear sense of what they are. And I don't get the sense from bankers that they really understand either when they're talking to different companies.
We spent a lot of time talking to Anne-Marie about this. It's a big problem. CFIUS should not be a political wing of the government. It should be about national security risk. Just get the feeling that over the last few years it's become highly, highly political, in line with the objectives of whoever's sitting in the White House. I think that's a problem. If you truly believe there is a national security risk associated with a company operating in this country, we need to do something about it. And do something about it fast.
Yeah, and honestly, that has a bigger question with the likes of TikTok, say, than U.S. Steel, by all accounts. And so there's a lot of, consistency questions that a lot of people are raising.
One company is from a country who is an ally, and one company is from a country who is not. Sometimes it's as simple as that. That's the latest on that front. Let's turn back to the Federal Reserve. FOMC officials seeing a higher risk of inflation with new White House policies on the horizon. Fed Chair Jay Powell likening the central bank's path as walking into a dark room full of furniture. It's a shift from last month's message on recalibrating monetary policy. The former Kansas City Fed President Esther George writing, the rationale for cutting today is a little puzzling, notwithstanding it was expected given the forecast for inflation. Esther joins us now for more. Esther, wonderful to catch up with you. You've been on that committee, you've lived it. How bizarre was yesterday for you, just seeing the decision, looking at the forecasts and listening to the news conference?
Well, good morning. I do think it's a challenging time, as the chairman said. A lot of uncertainty is in the picture right now. But with inflation persisting above the Fed's target, and I think the FOMC has been very clear, they're not deviating from that target, it raises the question of how well this recalibration was positioned going forward. And I think we heard that yesterday.
Esther, what does it mean when they say they're not deviating from the target, but in practice they're lifting their inflation forecast and pushing out the date for the goal to actually hit the target? What does that really mean?
Well, I think it means the Fed understands its credibility is based on a commitment it made to 2% inflation. And we're now going on 4 years of a much higher level of inflation. And what I heard yesterday is confidence is not quite as strong as it was even 3 months ago, that achieving that 2% target in a reasonable time was in sight. And remember, this is so important because of inflation expectations. The longer the FOMC takes to achieve its 2% target, the more risk, I think, that comes around those expectations being unanchored.
Esther, do you think that it was the wrong decision then not to just remain on hold in this previous meeting, given the fact that essentially there was a good argument not to cut rates that Jay Powell himself made?
Well, I would have been comfortable with that, Lisa, given how we've seen the data come in. Remember, throughout this period of talking about restrictive rates, we've in fact seen the economy flourish. We've seen GDP come in above trend. We've seen the labor market remain stable. And inflation, of course, sticky. So those conditions, I think, obviously raise the question, and the Fed acknowledged it yesterday of saying we may have to be a little more deliberate here as we talk about a recalibration.
Esther, I was struck by the fact that I was looking for clues in Jay Powell's speech about how far we were away from away from neutral rates, how restrictive he really believes that we are. And he said two different things in the same press conference. He said at one point, we're not that far away from being at a neutral rate. At another level saying we still have fairly restrictive rates. Were you left just as confused about where the Fed lies when it comes to understanding what neutral they're looking for?
Well, I think the chairman has said this before, and it's true. They do not know what neutral is today. And so they are feeling their way. And the challenge, of course, is their most direct influence is on that inflation number. And obviously, they do not want to unseat a growing economy. They do not want to hurt the labor market. That's part of their mandate. But it is true that they must bring inflation down. And I think this pause, if it turns out to be a pause, is one that's warranted, given the fact that inflation has not returned to their target.
Esther, there was also a question about the politics surrounding this, the fact that a number of different members did take into consideration the potential for Trump policies to be inflationary. How much does that color your view of inflation, the stickiness? How much does that concern you about the political ramifications for the Federal Reserve?
Well, I think to begin with, we see an inflation problem aside from any policy changes that may lie ahead. In terms of thinking about your risk and where the risk lies, of course, you have to take that into account. And as you and I have talked about before on this show, one of the differences between now and what we saw in 2017 as the FOMC contemplated tariffs, for example, is that you're approaching your inflation target from a different place. And so that does raise the risk that have to be thought about as they go out. And we heard yesterday, people had approached their dot plots in different ways around that. So I wouldn't take that as the sole reason to be concerned. But I do think the Fed has to reiterate its commitment to its inflation target.
Esther, you lived it, and you've been part of that process quite a few times where you've had to put a dot out there, put some forecasts out there too. What was your approach, and why did you think that was the best approach? Do you take notice of the incoming administration? Do you wait for the policies? What was your approach?
So my approach, Jonathan, and this is a difficult process for anyone that does forecasting, is to try to follow some kind of a rule to make sure that you are being consistent in how you take in data and how it might adjust. Certainly, when you're thinking about the balance of risk, though, you have to look ahead and you have to say, are we coming into a period where it looks like we will be softening? Does it look like we are continuing to have a healthy economy? All of those factors affect the look ahead that influences what dots you're putting down for those out years. Completely imperfect, of course, but necessary to communicating how policy might unfold.
Thank you for sharing that clarity with us this morning, Esther. Enjoy it as always. Esther George there, the former Kansas City Fed president. I think that leads us to where we were a little bit earlier this morning, Lisa. His approach to the November news conference set himself up for failure in the December news conference. When he came out and said, we don't assume, we don't speculate, we don't guess, to follow that up a little more than a month later, to acknowledge that some people do basically speculate, assume, guess about incoming policy. He used a very different phrase to basically describe what I've just said, but ultimately that's where they ended up at this meeting. Some did, some didn't. I'd love to know who did and who didn't, because I'd like to know what their policies and what their forecasts would be if they knew what the incoming administration was actually going to do.
Yeah, this goes back to exactly to Esther George's point. What are the models they're using? What are the scenario analysis? I keep repeating that, and I know I sound like a broken record, but at a certain point, it's okay to bake in some assumptions. In fact, that is the job. The question is, how do you do so? And do you have a consistent way of doing it that can strip out some of the potential fervor from certain data points and market responses?
Stocks are doing better this morning. On the S&P, we're higher by 0.75%, a bounce back there, but not an unwind of the move we're seeing at the long end of the curve. Yields up yesterday, up again today by 2 basis points on 10s to 453, on 30s back through 470. Coming up tomorrow, look out for this. San Francisco Fed President Mary Daly joining this program, 7:30 Eastern Time. You do not want to miss that conversation. 30 minutes right here, live on Bloomberg TV. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Howard Lutnick is stepping back from running Cantor Fitzgerald. The announcement coming as he prepares for confirmation hearings for his role as Commerce Secretary under President-elect Donald Trump. Lutnick has yet to name a successor to head Cantor or the parent company, but his son Brandon, who was a trader at Cantor, will take over as CEO of the company's mostly recently created SPAC. Meanwhile, philanthropist Mackenzie Scott gave $2 billion to nearly 200 organizations this year. That brings the billionaire's total giving over the past several years to more than $19 billion. According to a statement on her website, about 75% of the groups receiving donations support the economic security and opportunity of people who are, quote, struggling. And a Florida county board has approved borrowing for the Tampa Bay Rays' proposed new stadium. The MLB team will receive more than $300 million worth of bonds from Pinellas County, with the Rays and their owner, Stu Sternberg, providing $700 million in addition to being on the hook for all cost overruns. It has been a difficult journey for the Rays to secure a new stadium in the Tampa area, which was only complicated this fall by damage created by 2 hurricanes to the team's current home. That's your Bloomberg Brief. John?
Yahara, appreciate it. More from Yahara again in about 30 minutes. Up next on the program, Speaker Johnson's uphill battle.
We got to get this done because here's the key. By doing this, we are clearing the decks and we are setting up for Trump to come in roaring back with the America First agenda.
That conversation up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bouncing back, session highs on the S&P 500, higher by 0.8% on the S&P, and the bond market yields higher by a single basis point, 452.61. Under surveillance this morning, Speaker Johnson's uphill battle.
Vivek and I talked last night about almost midnight, and he said, look, I get it. He said, we understand you're in an impossible position. Everybody knows that. Remember, guys, we still have just a razor-thin margin of Republicans, so any bill has to have Democrat votes. They understand the situation. They said, it's not directed to you, Mr. Speaker, but we don't like the spending. I said, guess what, fellas? I don't either. We got to get this done because here's the key. By doing this, we are clearing the decks, and we are setting up for Trump to come in roaring back with the America First agenda.
So here's the latest. President-elect Donald Trump and Vice President-elect J.D. Vance opposing a bipartisan deal to temporarily fund the U.S. government and avoid a shutdown, writing, Republicans must get smart and tough. If Democrats threaten to shut down the government unless we give them everything they want, then call their bluff. Former House Majority Leader Eric Cantor joins us now for more. Eric, good morning.
Good morning.
How difficult is it going to be to change the establishment in Washington, D.C.?
Well, you know, you're beginning to see, I think, a taste of what is to come over the next 2 years, because this is just a real desire to want to, you know, sort of clean up shop and to get on with a much cleaner, more focused, pro-growth agenda in D.C. And, you know, the problem is, even on these spending bills, if Republicans have majorities in both houses, which will be the case in January, you still are relying on Democrats to get things done, given the rules in the Senate. And, you know, when you see the activity online from Elon Musk and then the follow-up from President Trump, you know, it makes it really tough. I mean, because it defies the bipartisanship that is needed to get things done.
But spending taxpayers' money shouldn't be easy. It should be tough. And that's the problem that a lot of people have got with this. They'll use technical terms like continuing resolution. This is just business as usual. Then Lisa goes through all the other things that are stuffed into it, and the general public sits there and says, what's this about?
Right, and I think that's where certainly the objection came from Elon Musk and others to say, wait a minute, if this was a continuing resolution, which is just a stopgap measure, then let's just get over the hump so the government can continue to operate, but let's not do anything else. And this is the difficulty. When you've got a margin the way you do in the House and Speaker Johnson's dealing with, you need the Democrats to help you because you are not enjoying unanimity on the part of the Republicans. That's the issue.
That said, this was led by Mike Johnson. Mike Johnson started the tit for tat by that $10 billion provision for farmers. Look, there's a bigger issue here, which is that ultimately some of the bigger conversations about entitlements, about certain healthcare issues, about other big policies, people aren't willing to have in an honest way. How much do you think that that ultimately is the question? So you've got to kind of gussy everything up with all of these, you know, cute little tricks and get something through to just not do anything.
Well, the discussions that they're having around this continuing resolution bill are what's called discretionary funding. It is not what you're saying, the entitlements. And that, as you rightly point to, that is the real problem, and it's causing disproportionately our deficit and the growing debt. There's no question. But President Trump has said we're not touching that. Now, what I hope is with Elon Musk and Vivek Ramaswamy overseeing this DOGE effort, although it's not technically part of government, it can have a lot to do with the actual debate on policy. And I hope they're going to come up with something to define the debate, and hopefully it'll be clean up the way that these entitlements work so we can begin to see how we can reform those, because that's going to solve our debt and deficit.
You're at an amazing vantage point, understanding how the sausage is made, having a lot of contacts, and also seeing the business world react and being a part of that. And I'm just wondering how much the efficiency that markets have been rallying on is jeopardized by the dysfunction of trying to fix something that feels very, very broken.
So what I can tell you at Moelis, we are seeing our clients pick up in a big way the dialogue, their deals being dusted off, those that have been put on the shelf over the last several years, in fact. turning into, we've even seen a pickup in the acceleration, if you will, of completion of deals. And I think it's all about the optimism coming from deregulation, the fact that we're going to have an administration that is not an adversary to a pro-growth agenda and to business. And I think that just tells you where we've been in this country. You know, we have had and suffered a negative. You know, it has been almost a war on a growth agenda over the last 4 years under Joe Biden. And so I think that's ultimately going to prevail over any doubts about whether Washington in the end will get something done, because I still sit here today and say they will get something done to fund the government.
Compare the mood to that in Europe. How different is it right now? People are fired up about America into next year and beyond. And by people, I mean consumers. Confidence is up. Businesses, confidence is up. Compare that to Europe right now.
Amazing. And I spent all week in Europe, and it is amazing the difference of being here, looking at the optimism, the momentum we've got. It's reflected in the valuations of assets here. And you can see the unleashing of not only strategics here, but, you know, our sponsor clients. You know, everyone is sort of, you can really feel it. In Europe, everybody's looking here. I mean, that's the amazing thing, because there's a huge difference in valuation between on assets here versus Europe. And you would think, well, that would push people to go look for bargains over there. You've got investors and folks looking here. Everyone's coming here. It is striking. And now look, their political situation also is now the additional stumbling block that they've got to deal with, which doesn't bode well.
Yeah, whatever the fight looks like down in Washington, D.C., I think we should be very clear on a relative basis. The mess is elsewhere. Canada, Germany, France. The list goes on and on and on when it comes to political instability.
And it's not necessarily because those politicians are that much worse than the U.S., but it's that the U.S. corporate sector has managed to outperform again and again and innovate. And ultimately, that's what it's going to have to come back to.
I'll always say this, though. In our country, you look at the size of government as a percentage of GDP, we are much, much smaller, even though we, as a limited government conservative, you compare that to the EU, and they're 50%.
France pushing 60.
Yeah.
Eric, it's good to see you, buddy.
Great to be
Thanks
here. Happy
for your time.
holidays.
To you as well. Eric Cantor there, the former House Majority Leader. In the next hour, massive lineup, including the Secretary of State, Antony Blinken.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice.
because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
It feels a little bit like they're prejudging potential policy outcomes.
They did cut at this meeting. If they were front-running policy, they wouldn't have cut at this meeting.
I think today's message was they have less conviction about that downward path of inflation.
The Fed signaling and what we're going to get out of the Fed is just that much more uncertain.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, following the worst Fed day performance for this equity market in 20-plus years. Your bounce back looks like this on the S&P 500, higher by 0.8%. Across the board, you see the move on the Nasdaq, the bounce back on the Russell, the small caps up by 0.85%. We'll see if this sticks. In the bond market, that move did stick. Higher yields at the long end of the curve. It continues up another basis point on a 10-year to 453, on 30s, Bramo, up 3 basis points to 470.63.
To me, what really stands out from this morning's analysis is what Esther George said, formerly of the Kansas City Federal Reserve, that she would have been more comfortable with not cutting rates, and that essentially she leaned into this idea that ultimately there was a really good case to not cut rates based on that inflationary pressure. The concern now is, are markets going to think that this is going to be a Fed that was on autopilot and made an error in cutting rates at a time where inflation continues to surprise to the upside?
The question's been asked on repeat. We mentioned Steve Englander of Standard Chartered, who put in his note just yesterday, immediately after that news conference. If you were going to be so hawkish, why did you cut interest rates? It's one thing saying it's a close call. It's another thing cutting interest rates and then boosting your inflation forecast. What gives?
It was a very tortured message, and clearly there was a sense that there wasn't consensus and that everybody was looking at their own ways of modeling out how to judge incoming data. The result is people are questioning whether the Fed put is there, and maybe that's okay, because ultimately if inflation is the problem, then the Fed put is not necessarily on the table. And it also questions how this Federal Reserve and how different members are considering incoming policies, what that is going to mean to their scenario analysis going forward about what the balance of risks might be.
You framed it perfectly earlier on in the program. The easing bias of the Federal Reserve has been compromised. Now, compromised by what is where the debate is for me. Compromised by the incoming data? Possibly. Compromised by the incoming administration? Maybe. Which one was it? And if you ask one Fed official on that committee one question, the same question, they'll give you one answer. Another committee member will give you another. That's problematic for a Federal Reserve chair that's got to go into a news conference and try to offer some kind of consensus. And I think that's where the chairman had some difficulty, and where I'll find just a little bit of sympathy for him.
And the context is important, and I think that this is really what you nailed down, this idea that he said we don't speculate, we don't forecast. Well, actually, they do forecast, but he was sort of so dismissive of looking at what potential policies could look like at the November press conference. It is totally understandable to have uncertainty about policy, to look at what some of the proposals are, to look at the starting point of inflation and make some assumptions. but then don't shut that down, because ultimately the Federal Reserve has to speculate to some degree with their forecasts.
2 days after the election, it was easier to say that we don't speculate, guess and assume, because they didn't have to speculate, guess and assume. They didn't have to put out any forecasts. At the December meeting they did, and we said at the time, December would be far harder for them because they'd have to produce some forecasts and make some assumptions about the future. Where I'm at now, Lisa, is pretty clear. Are they going to be swayed again by one data point, by CPI, by payrolls on January 10th? Are we back doing something else again? Because this Federal Reserve, this committee, has been all over the shop. This market too, but this committee as well. Through 2024, the head fake for inflation of Q1, for unemployment through the summer. And I don't know how you describe this moment, but it's not the recalibration phase anymore going into 2025.
No, this is the foggy room, dark room with lots of furniture. Andrew Hollenhorst of Citigroup still thinks that this is a Fed that capitulates with many more rate cuts next year if there is incoming data, as he expects, that shows a labor market weakening at a much faster pace.
Equity futures bouncing back. We're higher by close to 0.9%. That's quite a bounce on the S&P following the biggest one-day loss going back to August. That's the equity market. In the bond market, yields bleeding a little bit higher through 450 on a US 10-year. Through 450, I believe, for the first time since May. Haven't seen these levels for quite a while. The 10-year at the moment, 453.21 and up by a further 2 basis points. Coming up this hour, we'll catch up with Darryl Cronk of Wells Fargo as the S&P 500 looks to bounce back. Secretary of State Antony Blinken as he rounds out his final days in office. And Francis Donald of RBC as the Fed looks to a more gradual pace of easing in the new year. We begin this hour with stock steady, the Fed denting the market's bull run, sending the S&P 500 to its worst Fed day in more than 20 years. Darryl Cronk of Wells Fargo saying a January rate cut should not be expected by markets. We look for the Fed to be much more deliberative and remain in a data-dependent holding pattern as it pertains to future rate cuts. Darryl joins us now for more. Darryl, good morning.
Good morning, John.
Are they hyper-data dependent? Is it one CPI print, one payrolls print that changes this story all over again?
I think that's a good question. I don't know that I'd describe them as hyper data dependent, right? I mean, if you looked at the last 4 CPI prints, they've all come in ahead of expectation, right? We put out our 2025 outlook several weeks ago. We actually think CPI ends 2025 at 3.3%, which is well above, almost a full point above where the street is, right? So we do believe, and therefore you can imagine we've dialed back rate expectations as well. So we had in early December, a December cut because we thought they were a go, and then one more for next year and then done. But if you back out of this whole thing, right, remember, we've raised rates 525 basis points in the cycle. Think about how you're going to put this in the history books, right? Then we cut 100 basis points today. So we're literally back to where we were in December 2022, right? We raised 123, we cut 124, so we just round-tripped it, basically. In December 2022, inflation was 6.5%, right? Powell stepped to the podium yesterday. He was a little bit of the Grinch, let's call it that, right? But he might have actually delivered a holiday present to investors, right? Because you take some of that froth out of the equity markets, right? We still have a 6,600 target next year. If you get down here around 57, 5,800, you're talking about 16, 17% return to that target. So we think there's opportunity, but we'd be cautious in the very short term. The rest of the year is going to get a little bit wieldy, I think.
You and everybody else, the median price target for next year on the S&P 500 is 6,600. Lisa's made the point repeatedly through this morning. It feels like the easing bias has been compromised. Yes. Does that not constrain this rally in any way, shape, or form in 25?
I think that's what markets are, wrestling with right now. I mean, think about it. You've taken the short side down 100 basis points, and the 10-year, you've talked about it all morning, has since the September 18th initial cut of 50 basis points, 10 years up 80 basis points. So down 100 on the short side, up 80 on the long side. You've steepened this yield curve meaningfully, right? That matters for equity markets. When you think about equity markets, though, remember this. We're 2 weeks away from year end, right? You step right into 2 weeks ahead of quarter end. What goes away? Corporate buybacks, right? They go into a blackout period. So you lose that buying power out of equities here in the short term. At year end, people are going to rebalance. What are they going to do when they rebalance? They have to sell equities because it's been a meaningful year and buy fixed income if they're just simply doing a stock bond rebalance. So that's at play. Tomorrow's triple witching, right, which is going to add volatility, right? We haven't talked about that at all, right? And then the last point I'd make is, if you look at technicals, right, yesterday we breached both the 20 and 50-day meaningfully, right, in the same afternoon from the 20, 50-day wides of the year, basically, right? That That's substantial, right? I mean, it's a pay attention sell-off yesterday afternoon. So the next couple weeks we think are going to get a little choppy here.
All I can say is triple witching. I never understand exactly what that means other than it sounds spooky. So things could happen that are a little bit strange. I do want to get into, and I know there's these different kinds of closing out of different contracts. But
we know you know, don't worry.
No, but I'm not trying to say it, but it's always, I'm like, what's the implication of it? Nobody could ever give me a straight answer.
Superior intelligence every time you speak.
Oh, so I'm just dripping with sarcasm. It's okay. All right.
You don't have to clarify.
Stop. All right, let's move on. All right, Daryl, there is this question, as you said, rebalancing into bonds and stocks at the end of the year. And I wonder what the takeaway is from you that we haven't seen more of a rally at the long end of the yield curve. I mean, that to me signals that people are truly worried that this Fed has lost control to some degree and that they cut even though they do see increased risks of inflation on the horizon.
Well, okay, so let's unpack that for a second, right? The long end of the yield curve is a term premium, an inflation premium, and a growth premium. That's basically what it is, and they ebb and flow and move. If I say, you know, U.S. GDP in the fourth quarter is going to close here with a 3 in front of it, and it may be after retail sales at 0.7 this week, maybe as high as almost 3.5%, and then take at least our expectation for a 3.3% inflation, right? Nominal growth is north of 6%. In that environment, right? Nominal growth matters, right? Because it's what corporate revenues and earnings are priced in. So it doesn't shock us at all that the 10-year's at 4.53 this morning. In fact, we said rates were going to be higher next year. Where we've been out of consensus, we think growth is stronger, rates are higher, earnings are higher next year because of that nominal growth, right? And so we found ourselves here as we turn the page a little bit out of consensus, but we're okay with that, and actually the markets are coming to us.
At what point does this leave the dollar in a precarious situation? I mean, really, this is something that John was asking about earlier, and I think it's a really important question at a time where it's been climbing and pressuring all the other economies of the world.
Well, I mean, so when we put out our outlook, you know, literally just weeks ago, we had 107 to 109 on the Dixie, right? It said 108 or 107.9 this morning. Everybody laughed at us when we said it was 108, 109, because they said, you know, the dollar's already come too far, too fast. Here it is, right? I do think it's curved from here. I don't think it gets much above 109, 110, but the fact that it stays there, right, and just grinds on particularly weak emerging markets, I think does matter, right? And it's also a point of fragility of if you get higher rates and stronger dollar, you know, that just really is hard on global economies, right? We already know it from developed, Japan, Germany, everybody else, but it's meaningfully hard. What you don't want to have is strong dollar break a weak emerging market in this kind of environment. That's where it becomes problematic.
I'm just wondering, next year you think growth is going to outperform, you think that you're going to get good returns from equities. What concerns you now? Does it seem like there is a bigger risk to an upside surprise for inflation,
yes,
or with the given shift in the Fed, that potentially there could be a downside shift to growth?
The former, right? I mean, I think you nailed it. Everybody wanted to talk about, you know, with the incoming President-elect Trump, a fiscal moment, bond vigilantes. I think the real surprise next year is inflation ends up higher and meaningfully higher. Again, if you use the consensus at 2.4, right? That's where the street is today. Like I said, we're at 3.3. We're almost a full point ahead. That's a game changer for how markets have to reset from here. We're not pricing in that expectation.
Markets were okay with inflation. Then we should reflect on that.
Right.
Top line revenue growth was decent. Companies had pricing power. Is this the kind of inflation that would be different, that companies would struggle with? Have we reached a tipping point for pricing power, for consumer price tolerance?
Not yet, right? Because again, I think with that strong nominal growth, but it is going to be harder on consumer-based companies to put that pricing power in, right? I do think you'll get it out of, you know, industrials, financials, you know, those types of places. But the consumer discretionary and/or to a lesser extent consumer staples, I think the pricing power is a little bit capped, if not dead in the water.
And that's got to be the big debate, Bramo, going into 25. If you get that inflation, okay, we've lived with that. It's terrible for consumers. Right. It's bitten really, really hard. But corporations had pricing power. and you saw that top-line revenue growth, you saw that strong nominal growth reflected in higher equity prices. Do you get a repeat of that, or is this time different?
You know, this to me is the key question. And do you get a repeat of that in the same industries? Or do you get a repeat of that maybe in the goods sectors at a time when the services sector saw the biggest inflation? That's one of the reasons why this has been so difficult. The different pistons of the economy that are firing, not in sync, that really create a muddy picture.
Darryl Cronk of Wells Fargo. Darryl, good to see you.
You too.
Merry
Thanks,
Christmas,
John.
sir.
You too.
Enjoy the holidays. Thank you. Thank you very much. If you are just joining us, equity futures here up by 0.8% on the S&P. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. House Majority Leader Steve Scalise says the stopgap funding measure is dead. The announcement coming after President-elect Donald Trump came out against it, threatening to oust fellow Republicans who don't meet his demands. Elsewhere, the Bank of England holding rates steady, the central bank signaling it will keep easing gradually in 2025, despite a growing minority of officials advocating for an immediate cut in borrowing costs. And finally, Formula One driver Sergio Perez is no longer with Team Red Bull, the team ending his contract 2 years early after months and months of poor results. Sergio has not won a race since 2023. His former teammate Max Verstappen has dominated, winning 9 races and his 4th consecutive title this year.
All I can say is we insult Ivy League football. You say the only thing is there is SEC football and F1, and then we do a brief about F1. All right.
Is that okay?
It's fine.
All right. Just wanted to squeeze it in.
All right. Okay,
Call it a
it's
Christmas
fine.
gift.
Merry Christmas.
Thank you very much.
Anytime.
Up next, the Morning Calls Plus, an interview with U.S. Secretary of State Antony Blinken. That's just around the corner from New York. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The open in about 1 hour and about 13 minutes away. Equities are higher by 0.8%. Let's get you some morning calls. First up, Jefferies upgrading Tapestry to buy, expecting continued momentum from the Coach brand. Your second call coming from TD Cowen, raising its price target on Boeing to 200, pointing to dramatic free cash flow growth potential. That stock is up by 1.5%. And finally, Bank of America downgrading Micron to neutral, highlighting weak PC and phone market trends. That stock getting hammered. Haven't talked much about it, Bramo, this morning. That stock is down by more than 12%. For the broader market, equities are doing better. We're bouncing back. We're higher by 0.8%. A big one-day loss yesterday, the biggest one-day loss on the S&P 500 going back to August. The worst Fed day performance we've seen on the S&P. I found this stat absolutely stunning. The worst Fed day performance in more than 20 years.
Yeah, well, ultimately, you raised this question going into this. Only one meeting did we see bond yields, we see the market sell off so far this year during a Fed decision. This time was different, and oh boy, was it different. And it raises this question of, does this signal a real shift, or is this just simply a market that got upended at a time where there was a bit of froth and not a lot of liquidity?
We've got an important conversation coming up very shortly with the U.S. Secretary of State, Antony Blinken, sitting down with Bloomberg's David Gura, so stand by for that. I think we need to spend a little bit more time speaking about the Federal Reserve. This easing bias has been compromised, I'm with you, and I think that's what really spooked this market yesterday. And you could sense it at the very beginning of the news conference when Chairman Powell was asked, why cut interest rates? We're looking at your forecasts. You've raised the outlook for growth, for inflation. You've dropped the outlook for unemployment. Why cut interest rates at all today? And he used this phrase and said it was a close call. And then when you dug a little bit deeper, what was behind the forecast, and you started to find out things like some people included the policies of the incoming administration, the uncertainty around them, and some people didn't. And you start to wonder, well, what would the forecast look like if they all did? What would the forecast be for interest rate cuts in 2025?
There are a lot of questions about how Fed Chair Powell, who has enjoyed consensus for so much of his tenure, handles dissent. Handles the idea that we're not necessarily seeing any cohesion with respect to the scenario analysis, the modeling, or what people think and expect for next year. And that's really creating a lot of uncertainty in markets that have equal uncertainty. So that, to me, I guess my question is, why did the market sell off so much? Was it because of that confusion? Was it because they cut rates at a time where they're still worried about inflation? Or was it the incorporation of theory from the potential Trump administration?
I always say this, it might sound a little too philosophical, but to work out where you're going, you've got to think about where you're coming from.
Correct.
We were pretty extended. We were talking about 12 days, now 13 days of negative breadth on the S&P 500, just one small part of the stock market doing the heavy lifting. We'd seen a massive run across a lot of assets. Lisa, you've seen the moves in the stock market, in crypto, on stocks like Tesla, single names that have had massive moves over the last month. It doesn't take much to spark a big unwind, and I think that's what we got yesterday. But we've said this a few times about Chairman Powell. Set himself up for failure when you come out in November and say you don't speculate, assume and guess. And then you have to put out some forecasts a month later where you have to speculate, assume, and guess. I don't think it gets any easier when we get to January. I don't think it gets any easier at all. We've got to figure out what this administration is going to do. We've got to figure out the consequences that will have. And as you heard from Eric Cantor a little bit earlier on this morning, Eric's making the point that people are fired up to invest in the United States of America and this economy through the next year and beyond. Never mind what that means for inflation. What does that mean for growth?
Ultimately, a lot of people are upgrading that. And really what Esther George said, I thought was really telling. It's not just about what the potential policies would do. It also has to do with where we're coming from and how much inflation's already in the system. And that, I think, was the biggest key. The inflation that they're recognizing already being in the system, heading into potentially an expansionary moment.
The difference, though, looking at 12 months compared to where we were 12 months ago, looking out a year, when we had the median year-end target on the S&P of 4,800 and then closed north of 6K in the last few weeks, and now everyone, I sense there is this real career risk associated with being bearish for 2025, which is why we have basically an average target on the S&P for year-end next year of 6,600. No one wants to miss it to the upside. That's a big change.
It is a big change, but it included the tailwind of a Fed with an easing bias. If that gets removed, how much does that change the outlook for next year? That, I think, is really what, for a moment, for a hot second, people were evaluating. And to me, I'm curious to see if this lasts, right? You could say low liquidity. You could say we were just taking froth off the top. But can we really say that if it continues into the beginning of next year?
Let's get you that conversation that we promised you. Joining us now with David Gura, the U.S. Secretary of State, Antony Blinken. We'll head over to you.
Thank you very much, and welcome to our audience on Bloomberg Radio and Bloomberg Television worldwide. Mr. Secretary, thank you very much for being here.
Good to be with you.
Many ways we could go here, but let's start with Syria. And you've described this moment as one of both promise and peril.
That's right.
You have what seems like a de facto government that is a designated terrorist group, and you've said that the U.S. has been in contact with HTS. What specifically have they said? I know there are other groups operating in the country as well, but what have they said about how they might govern if this is how it all shakes out?
what we've heard them say is positive. The question is, what are they actually going to do? We brought together with Jordan countries from around the region last week. We had Turkey, we had Iraq, we had the Gulf states, Jordan, Egypt, European partners. And we came together to set expectations. What is the international community? What are the neighbors looking for as this transition takes place in Syria? And we all agreed. We want to see something that's inclusive, that's non-sectarian, that respects minorities, women, that deals with any chemical weapons that may be remaining in Syria, that doesn't ally with ISIS or any of the terrorist groups that are there. And the reason that's so important is we want to make it clear to HTS and all of the emerging authorities that the recognition that they seek, the support that they seek and need from the international community, well, there's certain expectations that come along with that. And as I said, we've heard positive statements coming from Mr. Jelani, the leader of HTS, but what everyone is focused on is what's actually happening on the ground. What are they doing? Are they working to build a transition in Syria that brings everyone in? If they do that, and if they meet some of these other tests that the international community is looking for them to meet, then I think you can see something very positive. And here's what it is. For the first time in decades, the people of Syria can go forward without a dictator, without a terrorist group dominating their lives, without one sect or one group running things at the exclusion of others, and without foreign power calling all the shots. That's the opportunity, but it really requires HTS and other groups that are there to move forward in this inclusive way.
You've said that the U.S. wants to help, and I look at this country that has a lot of sanctions that are residual. A lot of sanctions have been in place for decades on Syria. Senator Chris Murphy of Connecticut has called for a temporary suspension of sanctions. Is that something that you would be amenable to, and would that be effective in helping you have more engagement with what may be this new government?
So we're looking at all the authorities we have. We're looking at all of the sanctions, not only our own. The United Nations has sanctions on HTS, its leader, and I think what we need to see is actual concrete steps, building an inclusive, non-sectarian government, a transition, eventually getting to an election. As we see these steps taken, then I think we'll be able to respond. Others will be able to respond. That's what we'd like to do. But we need to see concrete action, not simply positive declarations.
The EU's chief diplomat has said she's sending a senior representative to Damascus to talk to this new group, talk to this government. Is that something that you would want to do, that you can do, indeed, given the terrorist designation and the sanctions that are in place?
We've actually been in direct contact with HTS.
On the ground?
I can just tell you we've been in direct contact, and we're also looking at getting people on the ground in Syria. I think it's important to have direct communication. It's important to speak as clearly as possible, to listen, to make sure that we understand as best we can where they're going and where they want to go. So we'll be looking at pursuing that in the coming days.
Pull back and ask you another question about the region, and there's been a lot of speculation that a ceasefire deal could come together. When President Biden spoke about the deal between Israel and Hezbollah, he was asked at the end, do you think you could get a ceasefire deal by the end of your tenure? He said he's hoping and praying. Is there anything that's happened that gives more grounds for hope and prayer going forward here?
There is, and the reality is we should logically be able to get this. And I say that with all the caution that comes with that statement, because, you know, we've been very close before, and we've had these Lucy in the football moments where you're just ready to kick the football and Lucy pulls it away. But what's changed is this. Hamas knows that the cavalry is not coming to the rescue. For months and months and months, it hoped it would get a wider war with Hezbollah, with Iran, with Iranian-aligned groups coming in and creating more problems from Israel on more fronts and helping Hamas endure. We now know that's not happening. They know it's not happening because of the very important work that was done with us and with others, dealing with the unprecedented Iranian attacks on Israel, dealing with Hezbollah. So I think that's concentrated minds among Hamas on the need to complete this deal. Having said that, you know, it's always incredibly fraught, and it's very hard to get decisions made. It's hard to communicate, and for all of those reasons, even as close as it is, you know, it can still move in the other direction. But we've all been fanning out, working with all of the different partners who can make a difference and who may have some leverage with, communications with Hamas, whether it's Qatar, whether it's Egypt, whether it's Turkey, where I was just last week. The fundamental question right now is Hamas finally prepared to say yes? And if it does, we get the hostages back. we get a ceasefire, we get an immediate dramatic improvement in the lives of Palestinian children, women and men who've been caught in this horrible crossfire since October 7th of Hamas's making. If they really purport to care about the Palestinian people, they will say yes and do it now.
Let me ask you about that horrible crossfire, and it's something that you've written about in a recent essay for Foreign Affairs, the fact that millions have been displaced, tens of thousands have been killed, Gaza has been kind of reduced to rubble. You've made 12 trips to the region. How much regret do you have that kind of sustained level of humanitarian aid hasn't made it into Gaza over the course of this conflict?
You know, from day one, we've tried to do several things, going back to October 7th. First, to stand resolute with Israel to try to make sure that October 7th would never happen again. Second, to prevent this war from going wider, because if that happened, if other fronts opened up, whether it was with Iran, whether it was with Hezbollah, these other groups, more death, more destruction, and it would probably prolong what was going on in Gaza. And three, to do whatever we could to make sure that people in Gaza were getting the assistance they need, were getting the protections they need. And we have been on this virtually every single day, and we've seen moments when more assistance was getting through. Then we've seen moments where it's ebbed and flowed. But this has a dramatic effect on the lives and livelihoods of people in Gaza. The last week or 10 days, there has been a noticeable improvement, but we've seen that before, and then we've seen it fall off. The best way to finally deal with the needs of the people would be to end the conflict, would be to get the ceasefire, to get the hostages home. That's the best way, because you have an environment that is unique. You have a population that's trapped in Gaza. It doesn't have anywhere to go. In most other conflicts, people, they can become refugees. That's not a good thing, but it's better than being caught in the middle of a hot war. And also you have an enemy, in the case of Hamas, that's fully enmeshed with the civilian population, living in and under buildings, apartment buildings, schools, mosques, hospitals. That doesn't obviate at all the responsibility that Israel has to try to ensure that assistance gets to people who need it, and that people are protected as best possible. And we've been pushing on that every single day. We've also seen what's possible if there's real sustained focus on this. There was a polio vaccination campaign to make sure that little children in Gaza got these vaccines, and it was very successful. Until there's an end to the conflict, what we've been trying to impress upon the Israelis is the need to bring that same focus in a sustained way on getting assistance to people who need it.
I'll ask you a last question just about the transition that's underway, and you've said of this new administration, you want to pass the baton to them so they can get off and running. Forgive me, but it does seem like they are off and running. You had President-elect Trump meeting in France with President Zelensky, President Macron, he's met with Prime Minister Trudeau in Florida, his designate to be the special envoy to the Middle East, has been in the region as well. Does that complicate the work that you are doing, having that sort of separate voice, separate foreign policy, for lack of a better word, in the region while you're trying to do your work?
Look, there's one president at a time, one administration at a time, but we're in very close contact with the incoming administration. I spent a couple of hours.
It does feel novel, though. I mean, we used to talk about the Logan Act. It does feel like these are different circumstances.
Look, I think there are a few things. I think there are a few things going on. First, as I said, we've been in very close contact with the incoming administration. I've spent a lot of time with Senator Rubio and Jake Sullivan, the National Security Advisor, with Mike Waltz, his successor. We've had very good, not only conversations, but we're trying to make sure that we're as coordinated as possible so that they know what we're looking at doing in the remaining time that we have. I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges, because the world doesn't stop just because we're in a political transition. It's also normal that countries around the world want to hear from the incoming administration. They want to know what they can expect, and so they can get ready for that. As long as we're communicating closely, which we are, and as long as we're working to, again, try to make this handoff as effective as possible so that they can get moving on the run, because there's really no time to wait, then I think that's a good thing. And look, on the Middle East, just to stick with that quickly, we've been working very hard to make sure that, as best we can, we actually start to implement plans for a better future for the region, or if we don't have time to fully do that, to be able to hand them off. Not just getting the hostage and ceasefire deal, but having a clear plan for what follows, a day-after plan for Gaza, so that there's no vacuum that Hamas can refill, that Israel can pull out, and you can have Gaza stand up for its people. Administration, security, reconstruction. We have done an extraordinary amount of work carrying through what President Trump started with the Abraham Accords to get normalization between Israel and Saudi Arabia, which would be the biggest game changer in the region. And those plans are there and are in place and ready to go if we get an end to Gaza, a conflict there. We've done a lot of work on what a pathway to a Palestinian state would look like when people are ready for that conversation. They're not now. At some point, they're going to have to be. All of that is ready to be handed over to the new administration, and hopefully they'll carry the ball forward.
Very quickly before I let you go, you mentioned that normalization deal. It was something this administration invested a lot in before October 7th. Clearly, the conversations have been going on. There has been reporting that we're close to a breakthrough there. Is there? Can you shed any light on sort of where those conversations stand today?
So one of the things I look back on is on October 10th, a year ago. I was supposed to go to Saudi Arabia and to Israel to work on the Palestinian component of this normalization deal. And of course, that trip didn't happen because of October 7th. But even with Gaza, we've continued these conversations, we've continued this work. And in terms of the agreements that are needed between the United States and Saudi Arabia, they're pretty much ready to go. And that would then trigger the normalization between Israel and Saudi Arabia. But two things are required to actually get that done. One is an end to the conflict in Gaza, and two is having a credible pathway toward a Palestinian state. As I said, all of the work's been done, and hopefully we'll get to that end of conflict in Gaza. They'll have to engage the conversation on the answering the Palestinian question, but the work is there. And if that happens, this transforms the region. You have Israel that's integrated in the region. There's a common security architecture to deal with Iran. We saw that, something we put together embryonically when Iran attacked Israel in an unprecedented way, a direct attack. We not only, for the first time, participated in Israel's active defense, we brought other countries, including countries in the region, into that defense. So you can see what's possible in the future. But it requires an end to the conflict in Gaza, and it requires moving forward on the Palestinians.
Mr. Secretary, thank you very much. That's Antony Blinken, Secretary of State. I'll send it back to you.
David, thank you. It is quite a handoff. Two hot wars on the global stage and the most fragile geopolitical backdrop, Lisa, in decades. That is quite a handoff to leave behind.
And there's a question about what the path forward looks like and what happens in the next month as we sort of have this transition process.
Let's turn to the economic data. If you are just joining us, welcome to the program. Moments ago, we had economic data in the United States of America, including jobless claims. For the latest, we can bring in Mike McKee. Good morning, Mike.
Good morning. Well, you can talk how you want about overseas situations, but the U.S. economy still is the envy of the world. Growth, GDP, the second revision, third release, 3.1% as personal consumption rises to 3.7% from 3.5%. As Jay Powell said yesterday, the U.S. economy is in pretty good shape. Initial jobless claims dropped back to 220,000 from 242, a drop of 22,000. Remember last week we said it was influenced by the Thanksgiving holiday, and that certainly appears to be the case. The Philadelphia Fed business outlook down to negative 16.4 from negative 5.5. We saw something similar with the Empire Index, so it does seem we're seeing a bit of a manufacturing slowdown as new orders there drop to negative 4.3, shipments negative 1.9. Now everybody wants to know what prices paid are. This is interesting. Prices paid go up to 31.2 from 26.6, but prices received fall in half to 7.3 from 14.3. So it depends on which end of the invoice you are on, I guess. That basically is the story this morning. The U.S. economy in pretty good shape. The changes in the GDP number, basically personal consumption. We also saw a drop in the level of inventories to 57.9 billion. So that subtracts from growth. So overall, we're nothing to complain about here.
Put it all together, Mike. Retail sales earlier this week as well, pretty decent. The S&P Global Services PMI, pretty decent. Yields push higher. Again, Lisa, up another 2 basis points on 10s, up close to 4 basis points on a session on a 30-year.
Yeah, it raises this question, especially because the sell-off is disproportionately on the long end right now. You're actually seeing 2-year yields come in. I wonder if this is a bond market saying that this was a Fed that made a policy error cutting it all yesterday, especially given the fact that there aren't signs of weakness at a time where they themselves upgraded their inflation forecasts.
Some people do share that view. If you are just joining us, we're looking at a bond market with a 10-year through levels we haven't seen since May. Expectations for next year's rate cuts falling after yesterday's 25 basis point rate cut and all the changes you saw in the forecast from the Federal Reserve as well. Francis Donald of RBC writing, there is no consensus, no conviction in this FOMC, so trying to decipher their perspective/bias as a whole is probably a fool's errand. I'm pleased to say that Francis is with us around the table. Francis, good morning.
Good morning.
No consensus. Does that make it pretty tricky for the chairman to offer any particular view for 25?
Very difficult to give his view of what will happen, but not only is there not consensus from the Fed about what is happening right now and what's going on, but where will we be in 12 months? Now, no forecaster, public or private, knows where we're going to be in 12 months. We don't know what policies are coming through, their magnitude, their timing, but we do know the direction of where things will go, and that is that incremental policies will be inflationary and probably drag on growth. And this is why I think this is the problem for the Federal Reserve. It's not higher inflation. The Fed is not afraid of higher inflation. They know what to do. You hike rates or you keep them stable. They're not even afraid of weaker employment. You lower rates. What they're afraid of is a stagflationary environment. And if inflation heads upwards or is sticky for factors they cannot control, supply side, and the unemployment rate rises, or there's weakness underlying that labor market, maybe it doesn't show up in the unemployment rate, that is the big problem for the Federal Reserve heading into the next 12 months.
What do they do if that environment did materialize? What's the approach to that?
Well, they'll have to make some big decisions. So we heard from Fed Chair Powell, hey, we did work heading back in 2018 as to the type of inflation we should look through, giving himself some optionality. But this is a Fed that's going to have to ask itself questions over what type of inflation it does respond to. Supply side shocks, geopolitical fragility, these are not interest rate sensitive. So a Federal Reserve that talks a lot more about the type of inflation they would look through is one that might be erring on the growth side. For now, they don't have to make that choice because it's really the inflation side of the picture. As we just heard, the growth side looks on the surface at least to be well. I wouldn't be surprised if the Fed is also paying attention to the unevenness that exists under this economy. We talk about K-shape with incomes, high income folks really doing a lot better than low income folks, shows up in that retail sales data, but there's also that K-shape happening with manufacturing data and services data. This is not a simple economy. It's probably not a simple policy response. This, I think, is underscoring some of that confusion we're hearing from the Fed chair.
It raises this question of what kind of goals they have. I don't have a clear sense of what the goals are in terms of how quickly to get inflation down to 2%, in terms of how to weigh both the inflation reading and the unemployment reading, and what would trigger them to make a change. Did you have a clearer sense of that?
Well, from their SEP or those dots, they say it's okay if we wait several years to get back to neutral, okay if we wait several years to get back to 2%, and that seems to be okay by them. One of the challenges, I think, is this unevenness that exists under the surface. That unemployment rate is going to stay mechanically lower even as the labor market softens. This is a demographic story. And if we see deportations en masse, that could also contribute to the unemployment rate looking a lot better than the health of the underlying labor market. So this is a Fed that's going to have to look beyond its simple mandate, price stability and low and stable employment, and start asking questions about whether they're targeting the right numbers, or at least expanding the numbers that they're looking at in a more formal setting.
Does it make you more nervous to own risk, to buy risk, to take risk at a time of this much uncertainty and a real confusion, or at least disagreement among Fed members?
It will make anybody nervous to take risk. It will be more difficult for businesses to action on plans that they're going to take, or even for households to know what will interest rate policy look like moving forward. We're talking a lot about the market reaction and the idea that the market has moved to 2 or 1 cut for next year. That's fine, but how many business owners in the United States and globally incorporated a 10-year above 4%, and we're incorporating the idea that actually rate hikes could become part of the conversation? I don't believe that this is part of America's planning. And more importantly, I don't think it's part of the globe's plan, because let's not forget, this week we have China yields collapsing. We had 3 out of 7 G7 countries have governments that went through sizable periods of problems. And we have, as you noted, John, really serious geopolitical fragility. This is not a global economy that can withstand 4 to 5% rates, the same way the U.S. economy can. And while the Fed will say, we're focused on our own domestic economy, unfortunately, the rest of the world is going to be receivers of that Fed policy as well, and they are not in the same position as the American exceptionalism.
Saw that in emerging markets yesterday, that's for sure, in foreign exchange and EM. I'd love your thoughts on this whole debate around neutral. Ahead of this decision, Governor Waller came out and said we were some way off neutral, we could keep on cutting interest rates. I'm paraphrasing, but that was the essence of the message from the governor. Where do you think we are relative to neutral, and where are they? Because I was pretty confused by some of the commentary in the news conference.
Well, there's certainly this new concept of short-term neutral versus long-term neutral. So where we should be in the short term is different than where we should be in the long term. I think that's really being fueled by the surprisingly massive amount of fiscal spending. We, I think, in the general consensus, are downplaying just how impactful the most amount of spending per GDP that we have seen outside of a recession in American history. I mean, this is massive, and it's distorting data. And when we talk about American exceptionalism, yes, we have productivity and AI, but guess what? A lot of other countries could be growing at 3% if they were spending as much as the US was spending on the government side as well. So that's really distorting short-term neutral, but there's a lot of concepts being thrown around, and my sense is, as I listen to this is a lot of trying to find reasons why they can stay on hold. This is a Fed that wants to stay on hold until they get some sort of crack in the data in one direction or another. This is probably where they're going to stay.
Francis, it's good to see you.
Nice.
Always fantastic.
Nice
Thank you. Francis Donald there of RBC. 2 dates for the diary. January 10th, payrolls. January 15th, CPI. And Mike McKay, I wonder if this debate will change all over again when we get those data points.
Probably a little bit. But the data point that's going to matter is January 20th. And 21st, maybe, when we start to see the executive orders, because everybody is waiting to see what happens with Donald Trump's fiscal policies. I said yesterday, if the Fed decision and statement were on a milk carton, it would have an expiration date of January 20th on it.
Things could change a lot by the time we get inauguration and we get the changes to policies. We've all got similar questions. I want to know which policy officials did not include policy assumptions or uncertainty, however they want to describe it, for 2025, and what those median dots will look like when they all start to do the same thing.
Especially given the fact that one of the reasons why they cut by 50 basis points was because the SOM rule was triggered. There were rules that they were looking at to understand where we were. Some of these linchpins have not held up to be the same kind of predictive tools. What tools and measures are they looking at now? It's sort of like the legal constitutional tests that you use if you're on the Supreme Court.
Okay.
I'm going to stop.
You're getting all legal now.
Well, it feels very similar. It's economics Supreme Court.
Days.
I mean, basically, that's
law school.
Yeah, but let's move on.
That was another dream. All right. Michael Kush from Morgan Stanley with us around the table. Might want to move on quickly. Don't worry. It's a conversation for another day. Let's talk, sir, about what you think changed yesterday after that news conference with Chairman Powell.
What changed was that we've cut rates 100 basis points, year to date. Policy rates are 100 basis points easier, but the U.S. economy is stronger than it was a year ago, you could argue, with no sign that it's slowing down in the material world at the top headline level. Nominal GDP growth is strong, real GDP growth is strong. We had to slow down the pace of rate cuts. It's just, they had to. The question was, how do you transition to that slowdown? Do you do it incrementally, little by little, meeting by meeting, or you go like big bang? We're just reducing the expectations of rate cuts going forward in one go, and clearly the lack of consensus at the FOMC suggested that it was time to make that change.
Because, Michael, you've not liked long-term bonds for a while. You've been concerned about whether we're actually factoring in the inflationary and term premium types of pressure. Do you like them even less now, or do you like them a little more?
It's good. I dislike them the same amount. 10-year Treasuries got to 5% in 23. That was when inflation was higher, and there was worries about how strong the inflation, how long it would take inflation to come down. I think we're in a better position today, even though they're upgrading their inflation forecast for 25. We don't quite know why they're doing that. Is it because anticipating changes in the Trump administration policies, or are they really concerned that the economy is overheating in some sense? But I don't really think that's true, because then they have it going back down again in 26, 27, and it's taking a longer period to get there. I really think that the curve is just too flat, and that the economy is stronger than expected, and policy rates are not likely to go much below 4% anytime soon. So you need some kind of term premium to get people to buy long-term bonds.
When we look back on this press conference to cut rates at all, given the fact that they're talking about increasing their inflation expectation, and basically the data that we just got confirms the strength.
It maybe this gets back to, where is neutral? Where is the economy's trend growth rate? If productivity is accelerating and the potential capacity of the U.S. economy to grow faster than 2% is here, I would say maybe they should stop now. But 5.5%, again, all measures, seems a high number. We hadn't exceeded or gotten even a 5%, 5.5 since the 1990s, I think. We peaked 5.25, 5.5 in 06, 07. It's hard to believe that the economy is that much different. They need even higher interest rates than that. So bringing them down to the 4s in some sense seems equivalent to where we were pre-global financial crisis, in some sense a broad equilibrium for the economy given what we know. But if the U.S. economy can grow faster in the future.
Frances Donald of RBC was with us moments ago, just before you came on, and she was reflecting on the rest of the world. I'd like to finish there with you. What's going to happen to the global economy? Chinese bond yields are nosediving. There is a real conversation about that economy falling into the same disinflationary, deflationary trap that Japan entered all those decades ago. Europe's really struggling, huge structural growth issues. EM is battling with limited fiscal space in a world of climbing yields, which just means higher yields begets higher yields, and they've got a weaker currency to go with it and a central bank stuck in no man's land. What does the rest of the world do against this kind of backdrop? And how much can you stretch that band before it just snaps?
Well, a couple of areas. One is exchange rate depreciation. So you can offset it with that and support growth, but that usually has negative long-term income implications that your standard of living could fall as you use currency depreciation to support your economy, assuming you can do that. The other is fiscal space. Germany has lots of fiscal space. Germans don't like to use their fiscal space. So if they could use that, and the Eurozone has probably fiscal space in aggregate, but they're unwilling to use it. So the question is, will you use the policy tools you do have available?
The bond market's telling China they have that space too.
Well, it's, and they do, exactly. So you need to spur fiscal. We see it in the U.S. economy post-pandemic. You spend money, economies do better. If the government spends money, pours money into the economy, things will get better. Now you have to manage that trajectory over time, and some countries have more flexibility than others. Yep. Brazil has troubles right now. France has some troubles. So not everyone has that flexibility, but the countries that do have that flexibility should use it.
Michael Cushman, Morgan Stanley, thank you. That's the conundrum that we've got for 2025. The economies that need the fiscal space and want to use it can't. The economies that should use the fiscal space and have the space aren't. That's a big problem.
And that has been the problem, a structural problem for some of the economies that are in the most trouble right now. And that's really going to be the tension setting up at a time where there aren't the governments in place to do anything because the governments are not functional.
Canada, Germany,
Correct.
France, trying to figure all that out for 2025. Up next on the programme, we'll set you up for the day ahead, and we'll catch up with Adrian Year of Barclays, looking ahead to numbers from Nike. We'll do all of that in just a moment.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure, to have, let's call it a structured solution, we think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Getting closer and closer to year-end. A few more items on the agenda. Your week ahead looks like this. Today, Nike earnings after the closing bell. Tomorrow, core PCE and UMich sentiment. Next week, if you're still around, Conference Board consumer confidence and durable goods. And on Wednesday, of course, markets are closed for Christmas Day. With Nike earnings coming after the close, let's catch up with Barclays' Adrian Yee, who joins us now for more. Adrian, welcome to the program. What are you looking for a little bit later?
We are actually looking for a miss, but the title of our preview note was that this is the first earnings call where you're going to have the new CEO, Elliott Hill, who had started kind of mid-quarter, sort of October 14th was his first day on the job. But the fact of the matter is there is a lot of heavy lifting to do here. The DTC, the direct-to-consumer, the digital channel, is showing signs of tremendous promotionality, and we've heard that from their channel partners as well as our own checks.
How much, Adrian, are you expecting to hear about a consumer that is able and willing to spend, particularly in the U.S., renewed focus on the U.S.?
So what's interesting here is generally holiday has been intensely promotional. 30% off, 40% off, even 50% off as we go into the holiday season. It started even earlier, right? I think I've been on before telling you that we've moved from Black November to Black October to even the tail end of September. So people knew that they had a shorter holiday, a very intense holiday with the consumer under duress, and they started to grab wallet dollars earlier. So the interesting thing is that I don't know if we'd call it healthy, but the fact is that we are 96% employed, and when you tease that consumer with a tremendous promotion, right? They've been annoyed that everything costs 25% more, and so now they think they're getting value when it's 30, 40, 50 off. So I think this is a very different reason for why Nike is under pressure. They are resetting the business. They're pulling, product out of wholesale, and they're liquidating it, frankly, in their DTC channel, that so-called franchise management.
Stock is up by 0.9%. Looking forward to the numbers later. Adrian, appreciate you dropping by. Adrian Yee there of Barclays, looking ahead to Nike, seeing some big hits and some big misses in that space over the past month.
Yeah, as there is this rearranging in terms of wallet share when it comes to, I think that's the jargon. Is it wallet share?
Something like that,
yeah. That basically running shoes have.
You sound like you know what you're talking about, Bravo.
I know almost as much as triple witching and wallet share and... Let's get to
the weekend. Yeah. Let's get to the year end. Let's do that right now. Coming up tomorrow, one more day to go for Bramo and myself. We'll catch up with Jim Caron of Morgan Stanley, San Francisco Fed President Mary Daly, Kathy Bosjancic of Nationwide, Subhadra Japa of SocGen. To all of you out there, thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Futures attempting to hold on to their rebound after yesterday's post-Fed wipeout. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, stocks staging a comeback after that hawkish Fed cut jolted global markets. Wall Street's biggest bull, John Stolfitz, will weigh in. Also, on the earnings front, Micron plunging this morning with weak demand for smartphones and PCs, hurting the largest U.S. maker of computer memory chips. And D.C. drama. President-elect Donald Trump opposes a proposed funding bill, increasing the likelihood of a government shutdown. All of that and more coming up. But let's take stock of these markets right now, because you can see the S&P 500 currently up about 0.7%. We had an absolute wipeout yesterday, down 3% after that hawkish cut from Jerome Powell and company. And you can really see that we're trying to dig out of the hole, but certainly taking a bite out of year-to-date gains. You take a look at the bond market, we are back above 4.5% on that 10-year Treasury yield, up 11 basis points yesterday, up another 4 basis points today, helped in part, of course, by that stronger than expected GDP reading that we got at 8:30. And I wanted to throw up the VIX as well. We got as high as 28 yesterday. Of course, that's still below the heights of the summer, but we're holding on to that right now, even though you do have some volatility draining from this market. That VIX still trading with a 21 handle.
Yeah, just incredible. Higher volatility, danger zone. On that 10-year, we're going to talk all about it. But first, we're going to look at some single stocks. Micron is suffering its worst drop since the pandemic. That's due to sluggish demand for its memory chips. But the company's CEO is optimistic about the second half of 2025. More on that in a moment. Micron, though, down more than 11% pre-market. Also watching Darden Restaurants, saw some same-store sales pick up for its biggest brands, Olive Garden, Longhorn Steakhouse. You have Darden up more than 9% pre-market. It is helping this firm's top Wall Street expectations for the year. Also looking at CarMax beat up more than 7% pre-market, thanks to a more stable environment for car valuations. Let's see if that sticks, Katie, with that higher for longer environment.
Absolutely, and that is what's in focus for markets today, that potential higher for longer environment. I was a bit surprised by how surprised the market was, given that, we've been talking and socializing the idea that the Fed is going to pause in 2025. But then you consider that Powell did say that the rate cut yesterday was a closer call than previous decisions. We were like 95% priced for a cut, so explains some of the shock and all, but even still.
Yeah, I am also surprised with that violent reaction, if you will, because you did, to your point, see the VIX ride higher. I am impressed by just how violent the moves in the 10-year have been, not just over the past week. Since the beginning of last week, it's more than 15 basis points higher. But since those September lows, Katie, you're looking at a more than 95 basis point or 93 basis point rise higher in that 10-year since those September lows. So that's just how wrong the market has been. That is real money on the line lost.
Absolutely. A lot of people nursing that hurt today. And you have to ask, where's Santa Claus? I thought December was supposed to be a pretty good month. Let's ask some of these questions to InvestNet co-CIO Dana Dioria. She joins us now. And Dana, we've been calling this a hawkish cut. I like how you phrased it in your notes, that this is a cut with a but. Of course, Jerome Powell having to add some asterisks to exactly what he delivered yesterday. Did this change your base case when you take a look into 2025?
No, I wouldn't say it did. And in fact, I agree with the comments that you just made. It's actually kind of perplexing that the market is still overshooting on its expectations for rate cuts, so much. And we've been doing it all year, right? I mean, we started the year with a massive rate cut expectation in the face of also an expectation that markets were going to do well. Employment is not suffering, and inflation, while certainly coming down abruptly, the Fed's biggest mistake right now would be to let inflation take hold again, right? I mean, that would be a fail for this Fed of all the things that they could do. And so, it does surprise a little to see that the market still continues to overshoot on these expectations of rate cuts. I think now remember, right? Trying to predict what the rate cuts are going to be next year. All you've got right now is the information of knowing what we know today. The Fed chair and governors are saying, hey, look, it's probably closer to 2. That's a base case going into 2025. It's really kind of meaningless, right? The only thing we could say for sure is it's probably not exactly that. They're going to be data driven all next year the way they have been this year. But it's more an understanding of the information that we have today doesn't support this expectation of a lot of rate cuts next year.
Well, to the point on the uncertainty about next year, I thought it was also telling that he was asked if he could rule out a 2025 hike, and the answer was no. Of course, there's so many cross currents, so many unknowns, especially when it comes to the fiscal side of the equation. Economists have a lot on their hands, but how do you approach that from an investor standpoint? The possibility that we could have hikes enter back into the conversation.
Yeah, I think when you're thinking about advisory assets, which is what the InvestNet platform has, right? It's financial advisors and how are they allocating retail client assets, and for the most part, they're not going to make major changes in their portfolio allocations based on whether rates are going up or down. But what they might be thinking about is how close is my client to their existing risk tolerance? Is this something where I've been pushing on the equity side a little bit, or clients have been, kind of pushing me into maybe, or pushing for rather, some higher allocations in a risk-on sort of a framework, and should that be rethought? So it's going to be, for many advisors, right? They're sitting in a portfolio that's based on long-run expectations for that client, long-run, goal setting, et cetera. So incremental changes, I wouldn't expect much. Another place I do think, though, is going to be relevant is how much money people have sitting on the sidelines in cash. We've had a year of just because rates are higher and you can earn more in these cash vehicles, you have a lot of money sitting on the sidelines that probably did belong in the market. And if you look at it, yes, you've earned a lot more in cash than you were in the last several years, but you missed out. If that's long-term money, you've missed out on really big returns in the market. And so I think the expectation that we have higher for longer could leave more money in cash, and that hasn't really panned out well for people.
But if you think about what's ahead, you're still looking at sky-high valuations, at least relative to what we've seen. We're still near record highs. And what is the case then for taking that cash out now? Why wouldn't you wait for a greater pullback, especially if you believe that we're going to still be in that higher for longer environment?
So that, you can go at it that way, right? I mean, we recommend that you not try to time the markets. It's notoriously difficult to time the markets. And so if you're sitting in cash and you're saying, look, at some point, I expect some sort of correction here or some of this exuberance to kind of come off, you risk that you miss rapid returns in the market. You don't know when those are going to happen. And as we know, when you look across, if it's 10% return in a market cap weight over time, it doesn't come, unfortunately, as 10%. It comes as negative, 10 and then 30% at another time. And so, our baseline recommendation is always, if this is long-term money, you're not trying to move in and out and figure out exactly when the market is going to do well. That, just having it sit in cash when it's something that you're not going to be tapping for 5, 10, 15 years, you probably are missing out on an opportunity. And again, we saw that happen this year. So we would say, that balance 60-40 is still a great place to put money. And yes, you do risk, of course, the chance that there is a pullback. I don't think that's certainly out of the realm of possibility at all. And there's a lot coming in the coming year, right? In terms of uncertainty around, you mentioned fiscal policy, what's going to happen with tariffs? What will happen with immigration? Is the rhetoric a lot stronger than what will take place? Perhaps.
It's interesting because I want to acknowledge some more of the economic data. Even after that shocker of that Fed report, you have a U.S. growth that was revised to 3.1%. Strong consumer spending was a real component of that. And you did see this year investors really wanting to bet on the consumer. You saw this consumer discretionary trade come back in fits and starts. But if you are concerned still about persistent inflation that could be under the hood here, how quickly could that tide turn? Is it still a bit of a dangerous trade given where we are right now?
So I think the consumer has certainly propped up, and I think what's propping that up, of course, is employment, right? We really haven't had, we've had some recognition, I think, and come across in numbers around a little bit of a cooling in the job market, but not any great degree. And that's, of course, what empowers the Fed to say, hey, we're really going to take it slow on rate cuts here. Of course, the Fed has a dual mandate, right? I mean, the stock market, notwithstanding what they seem to react to, perhaps, the stock market really isn't part of their mandate, right? Their mandate is employment and inflation. And so if you have a steady employer picture driving consumer spending, it really does empower them to say, look, we're going to be more concerned about inflation here. We know that inflation tends to come in waves. We don't want to take any chance that the inflation that we experienced, rears again. And so the bet on the consumer is really a bet on employment. I think when we're looking at data that's coming next year, and everybody will focus here, right, is what happens with that job picture? What happens with payrolls? What happens with the unemployment rate? We obviously have several different types of data points that come to us on employment. That's what's going to drive consumer spending, and that's what's going to drive whether that trade's going to work out.
And Dana, before we let you go, I do want to talk a little bit about crypto, which I wasn't expecting to do at 9 a.m. Post-Fed, but I'm taking a look at some of your notes. You note that on the InvestNet platform, you have about $6 trillion in assets, and at least $1.6 billion of that is in crypto. And I think that's really interesting. Of course, Bitcoin holding above $100,000. How are people actually incorporating it into their portfolios? Real investors, not necessarily just Bitcoin maxis.
Yeah, and those are, the ETF numbers, right? And so I think the big thing that happened in terms of the advisory world for crypto was the SEC decision that you can now have ETFs that follow cryptocurrency. And, that opened up a whole set of investors that wouldn't otherwise have been there, who don't want to worry about cold storage and, did I pick the right crypto vendor, et cetera. But now they have big asset manager names like BlackRock, like Fidelity, who are backing these ETFs. And so they don't have to worry about any of the operational considerations. It's just a question of, do I want a slug of this in my overall asset allocation? And when you look at the size of where crypto is, and there's indicators in markets that this is not, sort of just a retail phenomenon outside of the advisory world, you're seeing more now where not only advisory, but even institutional is bringing crypto into the play. You're seeing research out there that suggests that because crypto has such an opportunity to outperform, it's volatile, right? It's an incredibly volatile asset. So even a tiny slug in a portfolio actually raises the overall standard deviation of that portfolio in spite of, covariance potentially being low, right? And so you look at that, but at the same time, people even with a normal utility function might appreciate a little bit of crypto just because of the chance for it to have that lotto effect. And I think that's what advisors are looking at, in terms of those allocations. But, you know, it is a volatile asset, and you're really sort of looking at it from a lotto payoff, I think, to put it in.
And at least for now, holding steady this week, above 100,000, despite all that volatility in markets. Envestnet co-CIO Dana Daria, we thank you so very much for your time. We're going to also bring you some breaking news in the markets here because the Brazilian real hits record weakness. You are seeing that after central bank interventions. You're also seeing surging credit default swaps as well, which of course you would see in this kind of environment where you're seeing just that kind of weakness in the real. Stronger dollar, borrowing in dollars would make it really tough for those companies, of course, and therefore you see that real-time movement. We will keep an eye on that as we go along. Shocking also, Katie, that you're seeing central banks elsewhere in the world really making a mark on their own markets over the course of the week. Now, we mentioned Micron earlier. Shares seeing their biggest drop since the onset of the pandemic after providing a weak forecast. The company is now struggling with low demand for phones and computers. Bloomberg Technology's Caroline Hyde is at the table to discuss Micron and the tech trade. There were such high hopes, and you saw what happened with Broadcom just in recent days. There was excitement around the broadening trade outside of NVIDIA. Micron disappointed.
High bandwidth memory isn't disappointing, though. And that's the AI trade. That's the sexy part, which still goes great guns. And actually, give credit where credit's due to Sanjay Mehrotra, the CEO. He saw 84% increase in revenue in his fiscal quarter just reported. And he's seeing earnings up 300%, but we don't care because it's about the forecast. And it's the forecast that significantly underwhelms, coming in more than $1 billion shy of the market consensus when it comes to revenue. This is all on the back of PCs and smartphones. Good old back to boom bust when it comes to the inventory, of NAND in particular. This is a type of flash memory that is used across PCs, across smartphones in particular. And we're not upgrading as much as we used to, so that weakness is still feeding in, and it's not going to get better until the second half of the year, he says.
And it's interesting. We know that Micron, of course, really in the hurt locker today. It's been lagging the overall market, only up about 21%. But tell us about the competitive landscape when it comes to memory chips. Is this a Micron problem, or is this really an industry-wide sort of slump?
I think we're back to weakness across the board when you're looking at PCs and smartphones. We've heard this time and time again come from the other players. And that's why everyone's been putting all of their focus on this high bandwidth memory that goes in to adjacently work alongside the GPUs at NVIDIA and help the AI accelerators all get powered up and move forward. That is why SK Hynix has been all in on that trade. Samsung been desperately trying to. And overall, Micron, the biggest maker of memory chips here in the United States, has wanted its innings too. This is a company that is having to navigate so many headwinds. You and me as the consumer not upgrading our phones, but also it's got exposure to China. About $3 billion of its $25 billion for the full year of 2024 comes from China. What is the issue when it's in the push and the pull of the politics that is the trade war that we're currently experiencing?
That's true. It's industry dynamics, but it's also geopolitics. Really looking forward to the coverage on Bloomberg Technology, of course. That is Bloomberg's Caroline Hyde. Catch her on BTech at 11 a.m. But don't go anywhere, because coming up, President-elect Donald Trump shaking up Washington again as he trashes the House Speaker's plan to avoid a government shutdown, and actually just telling NBC that he would support abolishing the debt ceiling. We'll get into all of it next. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In case case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
There are a few things going on. First, as I said, we've been in very close contact with the incoming administration. I've spent a lot of time with Senator Rubio and Jake Sullivan, the National Security Advisor, with Mike Waltz, his successor. We've had very good, not only conversations, but we're trying to make sure that we're as coordinated as possible so that they know what we're looking at doing in the remaining time that we have. I want to be able to hand off to the incoming administration the best possible hand to play in all of these areas, in all of these challenges.
That was outgoing Secretary of State Antony Blinken speaking to Bloomberg's David Gura about the Trump transition. And speaking of the Trump transition, let's talk about the federal funding battle reaching a tipping point. President-elect Donald Trump opposing a proposed stopgap funding bill that would keep the government running. He just told NBC that he would support abolishing the debt ceiling. So let's talk to David Gura. He is the host of the Bloomberg Big Take podcast. He's sitting to my left. Of course, this was a bipartisan agreement. Now it's in jeopardy. Talk to me about the Elon Musk of it all.
Well, here we go. I mean, I think we kind of expected that there would be events like this during the course of the Trump presidency, the second Trump presidency. But the Elon Musk of it all is that he, in this kind of unelected but powerful person within the Trump orbit, has been swaying things in different directions. So he's tweeted, I think, more than 100 times about what was in this bill, which was a substantive 1,500-page
I did actually
resolution.
try to scroll back, and it was impossible.
Too many of them.
Yes.
Too many posts on X. So what we have now is both, all told, Musk, J.D. Vance, and Donald Trump coming out against this. And this is a bill that we had Mike Johnson put together over the course of many months, and there was just a lot of blind hope and optimism that it was going to get through before this shutdown deadline this week.
Speaking of Mike Johnson, I'm glad you brought him up. You have the president-elect really commenting on his role here. What does this mean for their relationship heading into next year?
You know, he has very assiduously tried to create and cultivate a good relationship with the president-elect, and this now throws all of that into whack. So now pivotal moment, aside from the shutdown deadline, is January 3rd, when there's going to be a speaker election. And remember just how he got the job in the first place. It was this long string of votes to find a House Speaker. He was by no means at the top of that list to begin with. So one wonders about how he is in Trump's estimation. It's kind of a fool's errand to try to figure that out. But certainly he's in a very precarious professional position at this point.
Does Joe Biden factor into this at all? Is the current administration a factor in this in any way? Or is this really just, President-elect Donald Trump hitting the ground before Inauguration Day?
I used to live in Washington and cover Washington, and no administration likes to see a government shut down. It has huge negative effects on people and their lives, and so we've seen that kind of messaging from the White House, again, as we have in kind of run-ups to shutdowns past. They're doing the same thing now. I think they're worried, but squarely now the ball is in Congress's court in a way as it has been all along. So I expect we'll hear them weigh in on this, but it really is up to Congress to figure out.
I want to also go back to that conversation. We came in with it, that conversation with Secretary of State Antony Blinken about what's happening in Syria, about what's happening really across the world at this point. But when it comes to Syria in particular, I thought your conversation was very interesting on how he sees the path forward evolving and how they might start to approach sanctions policy.
They're in a really tricky position right now because the kind of de facto leadership of that country is a group that the U.S. designates as a terrorist group. And he has acknowledged the fact that the U.S. has reached out to that group. There have been conversations, but I said to him, look, this is a country that's sort of heavily sanctioned. You have this terrorist designation, but you have these sanctions in place. We've had a Democratic senator, suggest that those should be suspended temporarily. I asked him if that was something that he would consider, so how he's looking at sort of the sanctions picture and his ability to sort of engage with what may be the new government in Syria.
Well, we're looking at all the authorities we have. We're looking at all of the sanctions, not only our own. The United Nations has sanctions on HTS, its leader. And I think what we need to see is actual concrete steps, building an inclusive, non-sectarian government, a transition, eventually getting to an election. As we see these steps taken, then I think we'll be able to respond. Others will be able to respond.
He stressed to me that this is kind of a moment when the U.S. is watching hour by hour to see what's happening here. There are a lot of groups kind of vying for power in the country. There is this one group that's backed by Turkey and was affiliated with al-Qaeda before, now seems to be coming into power, having shed a lot of that history. They're waiting to see sort of what happens here, and I just brought up with him in that conversation as well. Sort of, we've been here before, we've seen these power vacuums emerge. This is a particularly precarious time for a country like Syria when there is kind of wait and see what's going to happen, who's going to be in charge.
David, really great interview. Thank you so very much for bringing it to us. That is David Gura of The Big Take. You can listen to more of the Blinken interview and more on The Big Take podcast anywhere you get your podcasts. Stick with us. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan. The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a look at futures right now. Seconds, minutes away from the opening bell. You can see trying to rebound on the S&P 500, which of course fell by nearly 3% yesterday. That was its worst daily drop since August. Its worst performance on a scheduled Fed day since 2001. So quite a hole to climb out of. You take a look at big tech. You take a look at the small caps as well. Really feeling the pain yesterday, trying to stage a rally today. We'll see if that holds. And we'll discuss the base case next with John Stoltzfus. He is currently Wall Street's biggest bull, a 2025 price target of 7,100. We'll ask him whether that's changed. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
All right, we are moments away from the start of trading on this post-Fed day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. Of course, the reaction was swift and brutal yesterday to Jerome Powell's comments and that dot plot, penciling just 2 rate cuts next year. Also, Jerome Powell not ruling out a rate hike in 2025. That really spooked the bond market and that spooked the stock market. But you can see, at least in futures, trying to regain some of that momentum that we've been enjoying in 2024. And nevertheless, the bells ring. You can see down at the New York Stock Exchange core bridge. You take a look over to the NASDAQ right now, and someone else is ringing the bell there. In any case, let's get to the market action because that's what we're really excited about. The S&P 500 currently higher by about 0.7% in the first few seconds of trading. Big tech too, also managing to build a rally here. Small caps are interesting, of course. Really, this index taking a beating yesterday. Those small companies really banking on lower rates in 2025. That was worth a 4 to 5% decline yesterday, but of course, the Russell 2000 up about 1% at this moment. We'll see if that holds. But let's get under the surface right now because it's still earnings season. And we did get Darden Restaurants, of course, which provided a forecast that topped Wall Street's estimates as its largest brands generated positive same restaurant sales. That is worth an 11 to 12% gain. We also have to highlight CarMax. These are both happy stories. CarMax jumping after quarterly sales and revenue beat expectations. The CEO said that stable car valuations helped the company outperform. Shonali, that's good for a 10.7% increase.
Pretty impressive. I'm also keeping an eye on some stocks reporting after the bell. Earnings season still not over. Heading into the end of the year. Nike up about 0.6% as the market opens. The new CEO takes his first earnings call with the street, looking for information that could revive the brand, making Nike cool again. Listen, Nike has been down almost 30% this year alone. FedEx is also expected to report a profit boost for the most recent quarter. And we're going to listen to details about holiday activity. We're also taking a look, of course, at Micron, down bigly, more than 14%, almost 15% as the market opens. Its 2025 forecast disappointed. Micron is the largest U.S. maker of computer memory chips, and its CEO expects a return to growth in the second half of the fiscal year. We're going to take a closer look at Micron with Bloomberg's Abigail Doolittle.
It really is pretty impressive, Molly. This drop that we're seeing for Micron, the worst day since 2020, and this guide down is incredible as well. The worst or biggest, to my memory, for a major company. They are talking about $1.1 billion basically just disappearing. The EPS, not as much, but from the sales perspective, weakness for smartphones, weakness for PCs. Interestingly, the offsetting factor is AI demand for a particular type of component. But again, that weakness for smartphones and iPhone smartphones creating a big problem. In fact, on the shares, let's put it into the perspective of that worst day since 2020. Here you can see this massive drop lower, and this is a year-to-date chart, so we can't even see, but it's very clear that this is the worst day over the last year, the worst day since that massive selling pressure driven by the pandemic back in 2020. And then finally, well, how's Micron doing when we compare? Well, going into today, today's drop is certainly huge, but investors aren't entirely shocked because going into today, Micron was up just about 20% on the year. You compare that to NVIDIA up about 160% on the year, and then Broadcom up 100%, along with Marvell Technology up, let's call it 70-75%. Well, Micron was already suffering. Now, just up single digits on the year. This is a chip maker that is certainly underperforming relative to the peers, Katie.
Absolutely. I mean, it's operating in a pretty tough market right now. Memory chips for smartphones and PCs, definitely not enjoying what some of those chip designers are. But let's broaden out this conversation right now, because I'm pleased to say that we're joined now by Oppenheimer Chief Investment Strategist John Stoltzfus. He is the most bullish strategist for the S&P 500 on Bloomberg as of right now, predicting that the index will hit 7,100 by the end of 2025. John, it's great to see you in person.
Well, great to be here. Thanks, Katie.
So we do want to get to that price target, but let's look back first, actually. Let's talk about what happened yesterday. We were having this conversation right before the segment started that actually the seeds of what we saw in the stock market yesterday, it was the bond market tantrum that really set things off.
Yeah, I really think it was the bond market threw a real hissy fit, and on top of it, then it caught the equity market moved lower as well. And a lot of this has to do when you get change of policy occurring at the Federal Reserve, especially when you've had high levels of inflation and they've succeeded in bringing it down significantly. The process is never smooth. It takes time to realize the effects of a tightening cycle and then the beginning of a loosening cycle. And the Fed can't move too fast in either direction, really. It has to be careful. It's got a dual mandate to maintain an economy that can grow at a sustainable pace without a lot of inflation, at the same time not causing unemployment that would rise above 3 or 4%, which is considered full employment. We continue to feel that the Fed's doing the right job here. The consumer's in good shape. Businesses are in good shape. We just saw the third quarter earnings were very strong. We expect fourth quarter earnings will be pretty good coming in when we get after the new year, when we see how those work. So all in all, we remain positive at this time.
And I mean, you can see the bounce back today. The S&P 500 up about 1% after that 3% decline yesterday. And square the circle of how surprising yesterday actually truly was. We were talking about this at the top of the show, that we've been talking about the idea that the Fed will pause in 2025. Of course, to see that actually reflected in the dot plot seems like that shocked some people.
Yeah, you know, and some of it is just a desire to be shocked, we'd have to think. We're always reminded that there are many communities within the market at any given time, whether it's the stock market or the bond market, but it really is split between traders and intermediate to longer term investors. And the traders are looking for action. They are looking for opportunity, any catalyst that they can find within a bull market to take profits without FOMO. And they sure found it yesterday. And a lot of what happened was an unwinding of trades that are very complex. If you consider that this year looks a lot in parallel to last year. If you remember last year about this time, Powell intimated that the Fed would be cutting rates. He gave an idea, I think it was like about perhaps twice they were going to cut or so. Immediately, the bond market thought it would be many more cuts. They thought a recession was likely. And the reality is, this time around, you know, it's still a Ben Bernanke legacy Fed. It's highly communicative, but yet the market doesn't trust it. It just, you might as well have Greenspan in there for all the way that the market is acting. But the reality is the fundamentals remain remarkably good. And on a global basis, too, we stand out.
Speaking of fundamentals, it's interesting to see that jump back in the S&P 500 as we've been talking about this, more than 1% gain. Yes, it doesn't correct us for all that we've lost yesterday, but it is the biggest gain you're seeing in the S&P 500 since the election.
Right.
And so if that's the case, you're led higher today by financials, by consumer discretionary, you have strong earnings out there. How much do you believe in the broadening trade still, even with this recalibrated picture of what the interest rate story could look like and potentially some persistent inflation risks?
Well, very much do we believe in this broadening of the rally that we've seen. While it really has been, yesterday was a setback significantly, we think, for the progress that both mid caps and small caps had within the large cap space. 3% decline based on what the S&P 500 has done on a year-to-date basis, what the NASDAQ composite has done on a year-to-date basis. And the 11 sectors, at least 5 or 6 of those doing remarkably well this year in double-digit gains. We'd have to say it's a haircut. It's more than a trim. Last week's volatility was a trim, and this week is a haircut. But does not look like a correction about to happen. And a lot of it has to do with that uncertainty and the catalyst that it creates for bears to take advantage, to take some profits amidst a bull market that is undeniable in many ways, without FOMO. And it's the way the markets go. It's many sides to trades, but primarily 2 sides of the trades.
So if you are worried at all about what next year looks like, I know that you're not one of those bears, but what is the risk to your price target? What would cause you to rethink it, especially as we stand here today? We are below, even just with a haircut, we are below that emotional 6,000 level on the S&P 500.
Yeah, I think the 6,000 might well be achieved between now and the end of the year fairly easily. I don't know if my adjusted 6,200 target, that we went from 5,900 to 6,200, I don't know if we'll get to 6,200, but I'll take 6,000. But we might even do better than that. You never know. There's enough days left for Santa Claus to arrive and get a Santa Claus rally here. But in terms of what could be problematic, it's that argument between the markets related to is inflation still too sticky? Is the Fed overreacting to the stickiness of inflation? The desire for many cuts in interest rates by highly leveraged players in the market, who very much have the ear and the eye, both of the press and the audience, really, because that's where the drama happens. It's the action. You know, if you're an intermediate to longer term investor, and you look back to the 2 dates that were prominent in the reports today, what it was in March of 2020 and going back all the way to 2001, and then you look where the S&P 500 is from there. Oh my gosh, it's like, you know, it says it's a mistake to leave time in the market rather than trying to time the market. And the other thing is, we really do believe that the market is now comprised significantly of private investors who are investing like longer-term institutional investors for needs in a retirement, putting kids through college, leaving a legacy, a family legacy, or a legacy to a medical institution or a university. And that requires a lot of patience and the ability to get over quarterly disappointments and FOMC meetings that occur and take a look at the longer-term picture, which really does appear quite good at this point.
More people looking for that opportunity to set it and forget it, Katie. Oppenheimer Chief Investment Strategist John Stoltzfus, of course, the biggest bull on Wall Street. Thank you so very much for joining us, and happy holidays to you. Now, coming up, the head of Nike will face his first earnings call since filling the CEO's shoes. And Wall Street has a lot of questions for him. We're going to give you an earnings preview next. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Mizuho is upgrading Stanley Black & Decker to a buy. The firm also naming it a top sector pick, with the analyst saying that tools are bottoming and the tariff picture is now priced into the shares, currently up about 1%. Next up, we have Oppenheimer raising its rating on Block to a buy. The firm says that the digital payments company should see volume growth in 2025, and also that the company's Bitcoin mining strategy should fuel profit. And finally, we have Telsey Advisory Group downgrading European wax center, saying it's no longer a buy and cutting its price target. The firm cites concerns over the company's growth prospects, and the hair waxing salon recently hired the former CEO of Dave & Buster's to lead its operations. That is quite an interesting career switch. But in any case, let's talk about Nike CEO Elliott Hill, because he's going to face his first earnings call today since taking the top job in September. Wall Street, of course, seeking many answers when it comes to repairing retail partnerships, unifying staff, and making Nike's brands cool again. Here's what Dana Telsey of the Telsey Advisory Group told us on Monday.
He needs that core Nike brand to be new and different. Look what we heard, for example, on Foot Locker's call, where non-Nike branded product perform well. He needs to be at the center of the cultural conversation, and it's missing right now. How does he bring back that aura of a company who has such share and such resources available to them? I want to hear how he's going to instill that way to win and that swoosh that means something back in the conversation.
Joining us now is Poonam Goyal. She is a senior analyst for Bloomberg Intelligence. And Poonam, of course, it's a long to-do list for Elliott Hill over at Nike. What do you think should be first?
I think the first focus is to make himself and the brand more recognizable in the running and lifestyle categories. Those are two categories where Nike has literally let the share slip. And if they can win any of those categories back, even slowly, I think they'll make a difference.
How high are the stakes for him? Because even if the numbers are backward-looking in this regard, are there serious expectations for him to lay out a really credible plan moving forward? How high is that bar?
So we know the quarter will not be great. That's expected. But we want to hear from him. What is he going to do to turn momentum around, to get sales to rise again? It won't happen in the next quarter either. It will take time. But as we move into calendar 2025 and the end of their fiscal year, we should start to see some improvement. So will he outline a plan tonight? Probably not. But should we expect one in the near future? Absolutely. They delayed their investor meeting because he was appointed just around the corner then. And we do need to hear more on how he will revive the Nike brand, largely in running and lifestyle.
They also, of course, withdrew their full-year guidance, so they really wiped the slate clean for Elliott Hill. And I'm curious, I mean, we're waiting for a plan when it comes to their core business, but he has made some moves. They did sell off their virtual sneaker division. I'm not going to try to pronounce that, but they had bought that in 2021. How much more fat of that sort of vibe is there to trim when it comes to Nike?
There's not that much more fat. I mean, the biggest thing that he's done in my eyes is he's brought back leadership, right? He's brought back a team that was core to Nike to really bring Nike back to its roots. So I think that's one of the major things that he's done since he's been put at helm. And I think that will make a difference. As we move into calendar 2025 and the back half of their fiscal year, we should start to see changes in product. We should start to see them getting more involved in community. Both things that will make a difference if they're executed right.
And I just want to talk about the competitive landscape a little bit here, because you think about Nike's troubles, the issues they've been having over the past several years. In that time, Poonam, as you know very well, they have some real rivals take market share. You think about On, you think about Hoka's, for example. It's not as simple as just righting the ship. It feels like they have to take back market share as well.
They definitely have to take back market share, but what I will tell you is we ran a survey just recently last month, and Nike still remains the prominent brand when asked about what do you wear for running, what do you wear when you go out. So Nike has the mind share. They just need to win the share that they've lost recently. And when you look at the size of Nike and you look at the size of On and Hoka, yes, the growth rates have been exponential at the competition, but they still dwarf Nike. Nike is still 10 times bigger, at least, than either of those brands.
Poonam, we thank you so much for all of your analysis. That is Poonam Goyal of Bloomberg Intelligence, and looking forward to what happens today after the bell for the footwear giant, sorry. Coming up, companies that spent billions to buy other businesses during boom times are starting to regret those purchases only a few years later. Selling those assets now for a fraction of the original cost. We're going to talk about that next in our Wall Street Beat. This is Bloomberg.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to Bloomberg Open Interest. A quick check on that post-Fed rebound coming in a little bit. You can see the S&P 500 up about 6 to 0.7%. Big tech still higher, 0.5%, but we were higher in the pre-market. The Russell 2000 up about 0.9%. Volume, I will note, Shanali, is much higher than you might expect for December 19th. Currently trading 19 to 20% higher than our 20-day average right now on the S&P 500.
It's the day after the last day that mattered, and it turns out more days are starting to matter. Anyways, and it's time now for the Wall Street Beat. While overall M&A volumes have risen 16% this year, we are seeing still divestments of acquisitions that didn't work out in recent years. Take Alibaba for an example. It's selling the department store chain in time for $1 billion, and that's 30% of the company's valuation when Alibaba bought it. Bloomberg's Michelle Davis covers deals and joins us, and I remember the first assignment I had at Bloomberg, and it was to calculate the synergies across all of the deals that were done during the boom times, and many of them never came to the announced fruition of those synergies initially announced. So is that a cautionary tale going into next year when you're thinking about those 30, 40, $50 billion deals that are being discussed? Are some of these going to be just a bad idea?
You know, there's that famous line from Warren Buffett, when the tide goes out, you can see who's been swimming in their skivvies. And I feel like that really illustrates what's been happening here. A lot of these deals were struck during boom times, you know, an era of euphoria, interest rates were at rock bottom. And competition for deals was really fierce. So a lot of companies and potential buyers were really rushing through diligence. They were really rushing through deal processes because they wanted to be the one to buy these companies. But they weren't always taking the time to think about, you know, are the synergies going to pan out? What are the assumptions that I'm basing all of this on? And I do think we're starting to see that happen now with some of these, you know, companies having to really cut their losses. To come back to your question, I do see it as a cautionary tale, but I don't think we're quite in that environment now because obviously interest rates are higher and companies are having to be a lot more sober and reasonable about the types of deals that they're doing. That's why deal environments haven't fully recovered to what we were seeing, you know, 2017, 18 through 21.
Well, we have just over a minute left, but we opened the segment talking about Alibaba. Give us some more examples, for example, because I remember Just Eat agreeing to sell Grubhub. That was a pretty quick turnaround, and seems like they might have taken a bath on that one.
You know, there was another big one that happened during the pandemic time, Teladoc and Livongo. I think they paid around $15, $18 billion for that. They've written off so much of that value. I think Teladoc is now trading around $1 or $2 billion. In the healthcare space, there are a lot of these examples. I mean, CVS is right now under pressure because of some of the mega mergers that it completed years and years ago. And
$70 billion for Aetna.
Yeah.
Wow. Incredible.
And investors right now, they want to see profit. They're not rewarding growth the way they were before. And so companies are just being a lot more thoughtful.
You know, CVS's entire market cap is less than that now.
Yeah, CVS. We were talking about Micron in the Hurt Locker. CVS, truly another C-suite shakeup there, of course, which we'll be keeping an eye on. Michelle, great reporting as always. You're going to have a busy 2025, so enjoy the holidays. That is Bloomberg's Michelle Davis. And we take a look at markets right now. It'll be interesting to chat through the trade, of course. We're seeing this big bounce back, of course, but it's been an ugly week, and you have to wonder if we're going to see some year-end window dressing come in. Maybe we'll see Santa reappear, but certainly nursing a down week on the S&P 500. Coming up to talk through, of course, the Fed and everything else in the markets, we'll speak to Shannon Grind from Wells Fargo about that hawkish Fed cut, and then we'll talk with Tina Fordham on the looming government shutdown. We'll also speak with Dynex Capital's co-CEO discussing those mortgage markets and commercial real estate. Don't go anywhere. This is Bloomberg.
CEO right after a vacation than I am before vacation.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. We begin with breaking news from Georgia. We've learned the State Court of Appeals has ruled Fulton County District Attorney Fani Willis and her office should be removed from the 2020 election interference case involving President-elect Trump. The court concluding Willis' one-time romantic relationship with former special prosecutor Nathan Wade amounted to a conflict of interest. The 2-1 decision upends the last remaining criminal case against Mr. Trump. The president-elect tells Fox House Speaker Mike Johnson will keep his job if he acts decisively and tough on spending legislation. The remarks come a day after a plan to fund the government into the new year fell apart over Mr. Trump and Elon Musk's opposition. House Minority Leader Hakeem Jeffries.
House Republicans have unilaterally decided to break an agreement that would provide support for everyday Americans, keep the government open, and avoid a government shutdown. If you break an agreement, you own the consequences.
Luigi Mangione, the suspect in the murder of United Healthcare CEO, is in court in Hollidaysburg, Pennsylvania right now, where officials are expected to get the go-ahead shortly to transfer him to the city where the crime took place. CBS's Anna Schechter.
Things move really quickly as soon as that extradition waiver is filed, and as soon as that wraps, he can be transferred directly to New York.
CBS News has learned he will likely face federal murder charges once he gets there. We're learning of a possible twin plot linked to this week's deadly school shooting in Madison, Wisconsin. A man in Carlsbad, California has been detained for an alleged plan of his own. Correspondent Ian Lee is in Madison.
Court documents obtained by CBS affiliate KFMB say 20-year-old Alexander Paffendorf admitted to FBI agents that he was plotting a mass shooting with Natalie Ruffnow and told her that he would arm himself with explosives and a gun and target a government building.
Police say 15-year-old Ruffnow killed a classmate and a teacher before she killed herself Monday. A man in France who admitted to drugging and raping his ex-wife, Giselle Pellicot, repeatedly over almost a decade and inviting dozens of other men to join in, has been convicted and sentenced to 20 years. CBS's Leah Kinnery is at the foreign desk.
As the sentencing's wrapped up today, Giselle came out and spoke to reporters. She thanked everyone who supported her and said that she never regretted her decision to make the trial public.
And just in, Luigi Mangione has waived an extradition challenge, agreeing to be transferred.
IncomeTaxRelief.com.
New numbers on how long you might expect to be around this place.
Last year, nearly 3.1 million Americans died. That's about 189,000 fewer than the year before. Death rates declined across all racial and ethnic groups and in both men and women. The average life expectancy right now is 78.5 years. And the data from the first 10 months of 2024 suggests life expectancy for 2024 likely will rise. But CDC experts say not by a lot. Stacey Lynn, CBS News.
The government's responding to all of those mysterious drone sightings in one state. The FAA's issued a ban on flying drones in parts of New Jersey until January 17th without special permission from the government. And that would have to be for special security reasons. Sightings have been reported throughout the Northeast. Officials insist there's no evidence the drones pose a threat. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. We're also streaming live on YouTube, so check us out there. Coming up today, got lots going on in the marketplace. We're going to start off Henrietta Trez, Managing Partner, Director of Economic Policy at Veda Partners. Kim Forrest, Founder and CIO of Boca Capital Partners. Get her thoughts on the markets. Michael McKee, he does that economic stuff for Bloomberg. He's going to give us his thoughts on kind of the Fed, some of the economic data we saw today. But first, we want to get to some breaking news here. Luigi Mangione agrees to be sent to New York on murder charges. Not a good day for him. Let's get some of the immediate reporting. Miles Miller joins us, Bloomberg TV U.S. Managing Editor. Miles, what's the latest news there?
Yeah, so he was indicted in New York just a few days ago on first-degree murder charges for the fatal shooting of United Healthcare Group's executive Brian Thompson. He initially said he wasn't going to agree to extradition. He's got a new high-powered attorney legal team, and they told him that he should waive extradition and agree to be sent back to New York. Right now, he'll be picked up by detectives from the NYPD. They're going to fly him by helicopter back to New York, and then from there, he'll go to federal court in Lower Manhattan, where we expect him to face federal charges on this. What exactly those charges are, we don't know, but they're going to elevate, certainly, what happened in this case.
And the state charges are, as Alvin Bragg, the Manhattan DA, laid out the other day, right? We're still looking at first-degree murder, right? A second degree with an act of terrorism. Can you walk us through those charges?
Yeah, first-degree murder in New York State is usually reserved for the murder of police officers, EMTs, people, in New York who do a debt of service to the city. They added the terrorism enhancement. That's an enhancement that came after 9/11, but because they believed this was a really abhorrent thing that happened, and they want to send a message for that. We expect there to be federal charges filed in this case that may take this case over from state prosecution to be able to get around double jeopardy, and we expect those charges to focus on everything from having a gun unlicensed, which is against the federal gun licensing rules, to also include the murder that happened here. But we're still waiting on exactly what those charges are. Of course, this was about 3 weeks ago. CEO going to Investor Day when he was targeted by Luigi Mangione, who shot him in Manhattan. Then there's the manhunt for him that lasted for several days until they found him in Altoona, Pennsylvania.
Where is he going to spend his first night in New York City?
So depending on the federal charges, if he actually gets taken to 26 Federal Plaza, charged there, and then taken to 500 Pearl Street, he'll spend the night at the detention center, the federal detention center in Sunset Park, Brooklyn, where he will have folks like Sam Bankman-Fried and P. Diddy as folks who are currently stationed there. If he is only kept on the state charges, then he'll go to Rikers Rikers Island, the notorious jail here in the city.
All right, Miles, thank you so much. We really appreciate that. Just giving us the latest there from Luis Mangione coming to New York City, probably. And here we go. And this story continues to evolve, and we will bring you the latest reporting on that. So Miles Miller, Bloomberg Television U.S. Managing Editor. Let's go to the markets right here. Lisa Mateo. What do you got for us, Lisa?
Yeah, we got this business flash brought to you by IBKR, Interactive Brokers Forecast Trader. You can trade your views on key economic climate indicators. Visit ibkr.com/forecast. Get started today. All right, we've got stocks in recovery mode after taking a real nosedive yesterday. The Fed signaled a slower pace of easing. That was a reason for that. Right now, we have more economic data out this morning. Gross GDP increased at a 3.1% annualized rate in the third quarter. There was also an upward revision to core PCE numbers. Applications for U.S. unemployment benefits that fell last week after spiking earlier this month. 222,000 applications were filed. And just out, existing home sales for November. Now, the expectation was for 4.09 million, came in a bit higher at 4.15 million. So let's get to stocks right now. The NASDAQ up 0.5%, 105 points, 19,496. The Dow up 0.4%, 171 points, 42,500. And the S&P 500 up 0.4%, 28 points at 5,900. We have the two-year yield at 4.30%. That's down 4 basis points. And the yield on the 10-year 4.56%. And that's up 4 basis points. To currencies, have to point out the Japanese yen down more than 1% after the BOJ governor cast some doubt on hopes for a January rate hike. And then the pound, the British pound, is little changed right now. And that's after the BOE kept borrowing rates unchanged at 4.75%. The Bloomberg Dollar Spot Index is little changed. Pointing out shares of Micron Technology still lower, down 17% after delivered a revenue forecast that missed projections. And then home builder Lennar down 4% after its forecast for new orders in the first quarter missed estimates. After the close, it's FedEx and Nike. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Let me set the stage for you. So if you're a political commentator, as of yesterday, you're like, cool, I'm like really close to being on vacay. Like, I'm just going to get through the sea. The continuing resolution is going to happen. The government's not going to shut down Friday. I'm going to get to go to a beach and hang out and have a little drink with umbrellas. And then yesterday, after 4 o'clock, that dream gets dashed because President Donald Trump is now opposing House Speaker Mike Johnson's plan to avoid that government shutdown, instead now calling for a new approach that includes raising the debt ceiling, making it very complicated as to what that road is. Joining us is Henrietta Trace, Managing Partner and Director of Economic Policy at Beta Partners, not sipping on her little umbrella drink. Henrietta, why?
Alex, I feel very triggered by that entire introduction. I do not appreciate it at all. But that you're exactly right. I think that this is an incredibly smart move for the incoming Trump team. They have no skin in the game right now. He's not the president. And what's going to happen next year, as we've been discussing with clients for months now, is that they're going to have to face perpetual risks of government shutdown. And then in July, a debt ceiling negotiation with Democrats. Let's just think about the numbers here. In 2023, 71 Republicans voted against increasing the debt ceiling. There's only 10 blue dogs of the Democratic Conference of Moderates who might cross the aisle and vote for a debt ceiling hike sometime this week. So basically the math just does not add up for trying to get 60 votes in the Senate and 218 votes in the House to increase the debt ceiling in the next 48 hours. But it's incredibly intelligent of Trump to try to get it out of the way because it is going to be a massive impediment to the Republican agenda in 2025 if it's not cleared early.
If there's a government shutdown, won't the blame be placed upon the Republican Party? And if so, how's that calculus work?
Right. It always is. The blame is always placed on the Republican conference. They are the ones who instigate government shutdowns going as far back as Ted Cruz in, 2011, 2013. You know, it's plain to the American voter that Republicans are to blame. But there's a disproportionate amount of Democrats who care about a government shutdown versus Republicans who don't see it as too much of a big deal. The optics are obviously atrocious. You're going to send federal employees home during the holidays over Christmas without a paycheck in the next 2 weeks. You're going to shut all the national parks where Americans are traveling at pretty high rates right now over the holidays. So it's definitely not good optics. It makes Congress look dysfunctional. But what it's really showing us, and the Christmas present for investors right now, is that this is a precursor of just how dysfunctional Republicans are going to be next year. They have not had the votes for government funding bills for a decade. And usually it's Democrats who bail them out. And right now, Hakeem Jeffries and Chuck Schumer are holding their party together to say, look, this is your mess. You bail yourself out of this.
Yeah, I feel like I use that with my daughter sometimes too. But the debt ceiling issue, right? Like moving forward, the debt ceiling issue, so Trump won't have to deal with it in the summer, but instead that will come under Biden's watch. He said to NBC that he'd like to get rid of the debt ceiling altogether. How do you think that particular part plays out?
Yeah, I mean, that's very, expected from Trump. He, has famously said, let's just see what happens if you default. So I think his position on this is very clear. It's a nightmare for any president to have to increase the debt ceiling because you need to negotiate with the other party. The difference here is that you can, in fact, increase the debt ceiling via reconciliation. So if Republicans do not want to negotiate with Democrats, all they have to do is include a debt ceiling hike in the next reconciliation bill, which the Senate Budget Committee is hoping to mark up as early as the first week of January. So there is an alternative here, and Democrats know that. So if Republicans really do want it off the table, they have a path forward that they just need to carry the votes. They just need to find 217, and there have never been 217 Republican votes for the debt ceiling.
Henrietta, are you surprised that we have heard relatively little, if anything, from the Biden administration? It's President-elect Trump and his representatives taking all the oxygen out of the room about this topic.
Absolutely. I think that's a really important dynamic to all this. We know that Joe Biden, as president and even as senator, has always preferred sort of the diplomatic negotiated solution. Democrats generally believe the government functions for a purpose. And I think if Biden wanted to insert himself into this process, he could. But you're absolutely correct. He's been completely off the radar in this entire conversation, which admittedly only popped up in the last 24 hours.
So what do we think happens? Like, are we extending programming on television and radio on Friday to cover the weekend? Like, what are we thinking here?
Yeah, my odds of a shutdown are about 20% right now, which is admittedly very high for me. I'm usually in the 0 to 5% range of a shutdown, so I'm much higher than I usually am. But I don't think a shutdown is guaranteed. I think that Speaker Johnson and indeed President-elect Trump should want the government to stay open so that on January 3rd, they can get the ball rolling. They can elect their speaker. They can start passing a fiscal year 2025 budget, paving the way for a reconciliation bill on border, and then a future package on the tax package next year. That is, investors should take away one thing today. It's that the tax bill is going to take all year. It's going to be very hard to write, and there's a very strong chance that Republicans have to negotiate with Democrats on it. And that odds are growing as this debt ceiling and CR fight is exhibiting in real time. But I don't think we'll shut down. I think a very short term, maybe 2 week stopgap bill is what we're going to see probably tomorrow morning.
Interesting. Henrietta, thank you so much for joining us. I know you're super busy when all this news breaking here. Henrietta Trez, Managing Partner and Director of Economic Policy for Veda Partners. She is safely ensconced down there in New Orleans. She's like, I'm not going to Washington or New York, any of that silliness.
Yeah, but she's probably not getting the umbrella drink either. So
yeah, she's not getting the umbrella. She's got to work over the weekend.
There is that. What Terry Haynes said, which was quite interesting, he's like, look, the shutdowns don't mean anything, but what this does do is just put like another layer of uncertainty along with the Fed. It's really still about the Fed next year. That's going to be the issue. Definitely, obviously, stocks are rebounding from yesterday, but that was a really massive market reaction in a very short amount of time, which you would think if the Fed did what investors thought, why did it move so much? Or was it just an excuse to sell?
I think going from 4 potential cuts next year to what seems to be telegraphed as 2, that's the material item that's now confirmed for investors, and I think that's what impacted the market. We're getting a little bit of a rebound here today, so we'll stay on top of that. S&P up 0.6%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers Studio, I'm Lisa Mateo. We've got stocks advancing. This is after fresh economic data shows the U.S. economy expanded at a faster pace in the third quarter than expected. A big part of that, stronger consumer spending. I'm talking about gross GDP, which increased at a 3.1% annualized rate in the third quarter. Let's go to stocks. We have the NASDAQ up 0.7%, 140 points. The Dow up 0.4%, 175 points. And the S&P 500 up 0.5% or 31 points. The two-year yield at 4.31%. That's down 4 basis points. The yield on the 10-year, 4.56%, and that's up 5 basis points. To commodities, we have Brent crude down about 0.1%, $73 a barrel. WTI crude, $70 a barrel. We have spot gold higher at $2,591 an ounce. And the Bloomberg Dollar Spot Index is little changed. To earnings we go. We'll start with Conagra Brands. You know them, the maker of Slim Jim, Duncan Hines products. Their shares down about 2%, lowered its full-year profit guidance. It pointed to higher than expected inflation, also exchange rates. And then from food on the shelves, we go to dining out. Darden Restaurants, that's the owner of Ruth's Chris Steakhouse, much more. Their shares up 13%. Its full-year sales forecast beat estimates. And then we go to the used car market. CarMax shares up about 4%, beat quarterly earnings estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown and Manhattan. We are also live on YouTube, so go ahead and check it out. So I'm looking at the markets here, Paul. S&P is up 0.4, NASDAQ up 0.5. Citi was talking about the fact that they believe the equity sell-off was overdone. This is their Citi trading desk, saying that cuts being priced out due to inflation can be negative for equities, but those risks probably balance with things like corporate earnings growth, deregulation, friendly incoming administration, and a solid jobs market, hence the buy the dip today. Kim Forrest, founder and CIO of Boca Capital Partners, is joining us to discuss. Hey, Kim, what did you make of yesterday's sell-off, and what do you make of today and the bounce we're seeing?
Well, I love the market because in the short term, we always overreact, right? And in the long term, I have to say we probably get it right. And what I'm thinking is this. I don't know why anybody on earth is surprised that Powell comes out and says, hey, we're driven by data. Because that has been his MO ever since he had this position, right? And a couple of months of hotter than anticipated inflation, and it feels like it's global inflation. I'm sure they look at the U.S. primarily, but they're seeing global inflation bubbling up again. So rightly, they talked down the likelihood of, the 4 cuts to 2 cuts next year, and those are on the table because of data, right? So, but the market's kind of freaked out because it was looking at 1% lower on that overnight rate, and it's not getting it.
All right,
but it might.
So, Kim, as you think about 2025, given kind of, I guess, a little bit of a reset from the Fed here, how are you approaching next year? Where are you seeing opportunities?
Well, today, to be honest, I'm seeing opportunity in Micron, and that's mostly because, this is a very volatile stock that sometimes it says, hey, my customers look like the next couple of quarters, half of them are going to be light. So that is the phone and the PC market. But the other half, AI, has better margins and, they're going strong. So people are freaked out, once again, overreacting in the short term and selling off. So I think we're going to have areas like that where there are special situations where you might want to take a look at it. I think given all of the, I don't even want to say mayhem, but all of the disruptions just about in every area of our economic life, I think it's hard to say, hey, pharmaceuticals are going to win this year or pharmaceuticals are going to lose this year. It's all up for grabs. So I think you have to go stock by stock and look for good companies that can survive whatever the government and changes in regulation are going to throw at them.
I love that you brought up Micron because I was going to ask, because I know you like that stock. But what we learned about the stock reaction is that we're just sort of overdone a little bit, and that are we looking at excuses to sell? And what kind of environment does that set you up for in terms of equities that you're into?
Well, like, how long don't you want to own Micron? That's my question to you. If you're selling today, maybe you were one of the people that bought it when it was up at 150 this year and you're going to take tax losses. I could see that. I could see that being a reason to sell today. But do you really think over the long haul that we're going to use less storage devices, or, AI that uses unbelievable amounts of storage, both on the servers that it uses to create AI and, where it just stores stuff? Do you think we're going to need less storage? I think the answer is no. So all of this is really a timing issue.
All right, Kim, thank you so much for joining us. Kim Farris, she's a founder, Chief Investment Officer, Bouquet Capital Partners in Pittsburgh, Pennsylvania. Lots of economic news starting yesterday with the Fed. Our man, Michael McKee, he was down there. He flies down there. I have no idea why. You take the train. It's what the professionals do. But he flies, and he does it all the time, so I guess it works for him. Michael McKee joins us here in the studio.
Except when he's delayed, and then, he emails me about being delayed, and
he gets points.
He gets points.
Oh, well, that's true. He does get points.
You get points on Amtrak. But where can you go?
Yeah,
Washington, right?
That's a great point. Where can you go? Gee, I'd like to go to Providence today. All right, so Michael, you were down there in D.C. for the Fed meeting, the Fed press conference. Big reaction in the marketplace. What was your take?
I think it was a combination of things. It wasn't so much that they cut back the number of cuts that they're planning for next year, because that was sort of priced into the market, although some people say they expected 3 instead of 2. But I think it was the number of people who suggested they would have fewer cuts overall, and that their concerns are to the upside for inflation. And so you had a sort of reaction in the markets to that. And then we got to that frantic selling at the end of the day. And I think what we saw there was that people had said, well, I had a good year. I'm only going to trade for 2 more days. I'm leaving the office. I'm out of here till the end of the year. And so if my stocks are going down, I might as well get out. And that's what they did. And we saw that big rush at the end. I don't think that was so much Fed related as it was just sort of technically related, because you see, today we're back.
Yep.
Or it was triggered by the Fed, and then you hit some stops, and then you just have more selling. Mike, so we also had a lot of eco data out today, too. What were some standouts to you? Because this was now you get some time to dig through and give us a super cool, nerdy things.
Well, the biggest thing was the rise in GDP, 3.1% from 2.8%. Usually you don't get that big of a revision in the third report on GDP. Personal consumption, Americans are spending a lot, 3.7%. We also saw business investment go up from the initial reports. And overall, it was just a generally good GDP report that sets us up even better for the fourth quarter. And the interesting thing to me was when you look at that, you've got the incoming Treasury Secretary, Scott Bessent, saying that the Trump administration is going to have a goal of getting growth to 3%, which would mean, in this case, slowing the economy down, because the economy has averaged 3.3% during Joe Biden's term. So Jay Powell said yesterday the economy is in good shape, and it definitely appears to be. Jobless claims went back down again. No problem in the labor market. So overall, just a good news day.
And it feels like, again, if you look at what we heard yesterday and you look at some of the economic news today, I mean, you could see this Fed pause for quite some time next year.
If we still see this continued strength, then clearly the Fed is not too tight. And so they can just sit, which was sort of the point that Powell was making yesterday, that we can wait and see what happens because the economy is not falling off a cliff. We don't need to be cutting really fast.
To that point, if they do skip, pause, or whatever, hold, how hard is it to pick back up again?
Part of that will depend on how long they're on hold, and part of that will depend on inflation. If inflation doesn't start coming back down again and maybe even starts to go up a little more, then the markets are going to be calling for them to take action. If inflation comes down a lot, markets will also be calling for them to take action. So they can sit back and wait. And I think we're in a period of great uncertainty about what's going to happen with the economy. And so they can take direction from what...
But the longer they pause, isn't it hard to get the machine moving again?
Well, it's not hard to get the machine moving again. The machine is Wall Street, and Wall Street will react to whatever they do. They can, if it looks like the economy needs more cuts, then they can easily do that, and they'll start sending signals that they're going to do that. And you'll see the reaction in the markets. It was somebody said the other day that the Fed action, the fact that they cut rates, is not what matters anymore to the markets. Monetary policy is driven by their outlook, what the market thinks the Fed will do, because they have all this data at the same time as the Fed does, and so they look at it and they say the Fed should be doing this, and the Fed either ratifies that or goes in a different direction, but then the markets react.
What are your thoughts here about potential government shutdown? You've been through millions of these discussions.
Also, Mike was a political reporter in his previous lives.
Well, I've got a rule about Washington. Every time you think they can't be that stupid, they prove you wrong. A government shutdown accomplishes nothing. And the party that shuts the government down, which is almost always the Republicans, ends up regretting it because the American people blame them for this. And even though we've heard from Donald Trump that he would like to see this happen under Joe Biden, I think the Democrats would be able to make a good case that it was Trump's fault. And I don't think that matters because we're 2 years away from an election and people forget. What's almost more interesting is that Trump tied the debt ceiling to it. If they got rid of the debt ceiling, as there was a headline today that NBC says Trump would be in favor of that, that would be a fabulous thing. Get rid of the debt ceiling. It's just an anachronism. It's a waste of time.
So what? Yeah, give us your view, because I'm just learning about the debt ceiling.
Well, the debt ceiling is one of the worst features of our government, worst thing you could do, because it has no relation to what's gone on. It's basically we spent the money and now we're not going to pay for it, and that doesn't work. If you don't pay, then you don't get to borrow again, and that would be a really bad thing for the U.S. economy.
But in theory, the idea is to rein in spending, but that's not how it's actually.
Well, that wasn't the original idea.
Worked.
The original idea was, the reason they did that was because they used to have to vote on every spending bill to allow the Treasury to sell debt to do that. And when they got to World War I, they needed so much money and they needed to sell so much debt, and they just said, okay, you can go spend up to this amount. And then it just continually rolled over the idea, and then it became, in the mid-90s, a political weapon, where the party that was in power tried to hold the other one up.
All right, good stuff. Michael McKee covering all the economics for Bloomberg, getting a few minutes of his time here today. Lots of economic data, lots of Fed speak impacting these markets. And then the question of, is this government going to be open for business after midnight on Friday evening? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks, well, bouncing back after taking a big hit yesterday after the Fed cut interest rates for a third time and pointed to inflation as a challenge for 2025. We have the NASDAQ up 0.2%, 48 points at 19,439. The Dow up 0.3%, 138 points, 42,464. And the S&P 500 up 0.2%, 17 points at 5,889. The two-year yield at 4.29%, down 6 basis points. The yield on the 10-year, 4.56%, up 4 basis points. The Bloomberg Dollar Spot Index is up about 0.1%. Few companies making news. Foxconn in talks with Renault to buy its Nissan shares. That's according to Taiwan's Central News Agency. And sources say Volkswagen, labor leaders moving closer to an agreement that would keep its German car plants open. And Tesla shares really took a hit yesterday after word from the Fed sent shares down 8% this morning. Well, it's starting to get into recovery mode. They're up about 0.8%. There's also that report, though, that Tesla is in early talks with the city of Austin about its driverless fleets. And finally, this just in, Diageo is said to be considering a sale of Ciroc vodka. That's that brand once backed by Sean Diddy Combs. Shares in London, they are little changed. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance, and geopolitics through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. Speaking of geopolitics, Bloomberg's David Gura sat down with outgoing Secretary of State Antony Blinken earlier this morning on Bloomberg Television, and they spoke about a wide range of things, but particularly the ongoing conflict in the Middle East, including the future of Syria's government and the status of ceasefire negotiations between Israel and Hamas.
We're looking at all the authorities we have. We're looking at all of the sanctions, not only our own. The United Nations has sanctions on HTS, its leader, and I think what we need to see is actual concrete steps, building an inclusive, non-sectarian government, a transition, eventually getting to an election. As we see these steps taken, then I think we'll be able to respond. Others will be able to respond. That's what we'd like to do. But we need to see concrete action, not simply positive declarations.
The EU's chief diplomat has said she's sending a senior representative to Damascus to talk to this new group, talk to this government. Is that something that you would want to do, that you can do, indeed, given the terrorist designation and the sanctions that are in place?
We've actually been in direct contact with HTS.
On the ground?
I can just tell you we've been in direct contact, and we're also looking at getting people on the ground in Syria. I think it's important to have direct communication. It's important to speak as clearly as possible, to listen, to make sure that we understand as best we can where they're going and where they want to go. So we'll be looking at pursuing that in the coming days.
Pull back and ask you another question about the region, and there's been a lot of speculation that a ceasefire deal could come together. When President Biden spoke about the deal between Israel and Hezbollah, he was asked at the end, do you think you can get a ceasefire deal by the end of your tenure? He said he's hoping and praying. Is there anything that's happened that gives more grounds for hope and prayer going forward here?
There is, and the reality is we should logically be able to get this. And I say that with all the caution that comes with that statement, because, you know, we've been very close before, and we've had these Lucy in the football moments where you're just ready to kick the football and Lucy pulls it away. But what's changed is this. Hamas knows that the cavalry is not coming to the rescue. For months and months and months, it hoped it would get a wider war with Hezbollah, with Iran, with Iranian-aligned groups coming in and creating more problems from Israel on more fronts and helping Hamas endure. We now know that's not happening. They know it's not happening because of the very important work that was done with us and with others, dealing with the unprecedented Iranian attacks on Israel, dealing with Hezbollah. So I think that's concentrated minds among Hamas on the need to complete this deal. Having said that, you know, it's always incredibly fraught, and it's very hard to get decisions made. It's hard to communicate. And for all of those reasons, even as close as it is, you know, it can still move in the other direction. But we've all been fanning out, working with all of the different partners who can make a difference and who may have some leverage with, communications with Hamas, whether it's Qatar, whether it's Egypt, whether it's Turkey, where I was just last week. The fundamental question right now is Hamas finally prepared to say yes And if it does, we get the hostages back. We get a ceasefire.
That was Bloomberg's David Gura speaking with outgoing Secretary of State Antony Blinken earlier this morning. Joining us now is David Gura. David, great interview. It's always good to get this perspective, considering as he's wrapping up his term. Starting quickly with the logistics, how is the transition going in the critical area of the State Department?
You know, it's interesting. He said to me, it's funny, world leaders don't seem to acknowledge the fact that we're going through one. They want to kind of carry on as normal, and there's so much happening in the world. Their interest is in keeping that business going and also just trying to get a better sense of what the Trump administration might do or what policies might be concrete policies. So I asked him, you know, we have this kind of very strange and unprecedented situation where not only are President-elect Trump's aides holding meetings with other foreign leaders, but he himself is traveling to France, for instance, for the opening of Notre Dame, and he's meeting with President Zelensky and with President Macron. He had Justin Trudeau, the Prime Minister of Canada, coming down to Mar-a-Lago to meet with him to talk about trade policy. All of this stuff just doesn't happen, or it hasn't happened in the past. And Secretary Blinken, for his part, was pretty quick to dismiss that as being a distraction or anything that's complicating his job. But one has to imagine at a time when he's pursuing these very delicate negotiations that the U.S. is party to, be that for a ceasefire between Hamas and Israel or a broader normalization deal between Saudi Arabia and Israel, having the opportunity for an element of confusion if the president-elect tweets something out or one of his presumptive nominees comes and says something could certainly make things more difficult for them in this last month of their tenure.
David, with the few weeks remaining in their tenure, Secretary Blinken, does he have what level of confidence does he have that maybe something can get done? The hostages can be returned. Something with they can move forward with Syria in terms of a government there. How confident is he, or is because again the days are winding down?
Let me take each in kind, and so starting with the potential ceasefire deal, it's something that President Biden says he really wants to have happen before he leaves office. He says that he's hoping and praying that that comes to pass, and Secretary Blinken feels like he's getting to a place where that could happen. Now, of course, there are political considerations both in Israel and here in the U.S., and there is some speculation that Prime Minister Benjamin Netanyahu might just sort of wait this out until we get a new administration in Washington. So there's a lot of variables there too. Your other question about Syria, I mean, something that the Secretary stressed to me over and over again is how fluid the situation is. And what I really pressed him on is there have been moments in recent history when there's been political vacuums that have emerged in Iraq, in Libya, where you've kind of had a governing person disappear and there's nobody to fill the void. And so we're seeing that now in Syria, where there are all of these different groups, and the one that seems to be having the most currency is one that was affiliated with al-Qaeda before, is backed by Turkey, poses a host of complications. I think that at this point the U.S. is doing what it can to give that group and its leadership the benefit of the doubt, but proceeding very warily here, wanting to see it pursue policies and pathways that would be amenable to the U.S., but very with eyes wide open, recognizing the fact that anything could happen here and things could really turn in a different direction. Yeah,
speaking of, I mean, you can just look no further domestically than you look at the debt ceiling and President Trump saying that he wants to abolish it altogether and wrapping it in maybe to a budget for Congress and a continuing resolution. Do we have a clear roadmap of how now President Trump will be handling issues, whether foreign or domestic?
We're beginning to see that there's going to be some chaos infused into situations like this. So this is a kind of classic example on the domestic side. I think we expected this would happen when he became the president. We're seeing it happen beforehand. But the House Speaker had a continuing resolution prepared. It was big. There was a lot of stuff in it, but he felt pretty confident going into this weekend, into this deadline, he was going to be able to get that through. Now we're seeing that scuttled by the President-elect, the Vice President-elect, and Elon Musk, who's an unelected person with a lot of influence in that orbit. And so the House Speaker is now going back to the drawing board, and then adding more fuel to the confusion is President-elect Trump calling Garrett Haake at NBC News and suggesting he would be in favor of doing away with the debt ceiling entirely. Now, that couldn't happen here in this next couple of days, but I think there's a new level of nervousness on Capitol Hill that we are proceeding headlong to a shutdown, and we're going to see kind of a more confused process here going forward. And that, to your question about a playbook, I think that's something that we saw during the first administration, and for those skeptics who thought we wouldn't see it with a more mature or a different Trump, it seems like we're headed for it once again.
Yep. All right, David Gura, thank you so much. Appreciate that. David Gura, correspondent for Bloomberg and host of the Big Take podcast, and joining us here in our Bloomberg Interactive Brokers studio. Again, check out that interview with U.S. Secretary of State Antony Blinken. You can get that at Bloomberg.com on all the podcasts and kind of all that other digital stuff as well. It's out there in the zeitgeist, as Tom Keene would say. S&P 500 up 31 points. That's a 0.5%. NASDAQ also rebounding up 0.6%. This is Bloomberg.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube. Head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Big take story here out there. Stranded in Mexico, Trump's looming crackdown scares migrants. Let's get the breakdown of this story. Alex Vasquez joins us, economy and government reporter for Bloomberg News. He is joining us via Zoom here. Alex, thanks so much for joining us. Talk to us about this story because it looks like there's going to be a new sheriff in town as it relates to immigration coming in January. What's it mean at the border?
Yeah, well, so we pretty much wanted to know what's going on because we heard that Mexico was doing this crackdown on migrants after some negotiations with the U.S., and we wanted to see firsthand what was going on. So pretty much Mexico is detaining migrants in the north of the country, especially in, border cities like Tijuana or Ciudad Juarez, and they're sending them by bus to the south, to two states in the south, in the frontier, in the border with Guatemala, which are Villahermosa in Tabasco State and Tapachula in Chiapas State. So what's happening is, as they're waiting for a CBP-1 appointment, this is an appointment to try to get, a consular appointment with an U.S. official and request for asylum. They're stranded here in these southern cities, and they cannot travel north. But these are pretty small cities with no jobs opportunities. One of them has only one shelter, and we're talking about thousands of migrants, and this shelter only has capacity for like 83 migrants.
Oh, wow.
So they're pretty much begging for money in the streets with nothing to do until they can get an appointment. And if they try to go north, normally they're detained several times and sent back south. So they're having a pretty difficult situation, and besides this, they're being victims of robbery, extortions, kidnappings. So they're having a really bad time here in Mexico.
What is a solution here? Like, what's a plan B, C, D, E, F?
I mean, this was negotiated with the Biden administration by the end of last year and the beginning of this year. And what they wanted was pretty much, reduce border crossings because the election was approaching, and this worked for the U.S. I mean, right now, Mexico has more than double migrants detention since last year, and we're talking about more than 900,000. So it is working to reduce border crossings. But the thing is, they're stranded here, and they don't have pretty much opportunity. So the plan B, we're not sure because, we already heard that Donald Trump is going. He promised to do mass deportations from day one. So these migrants are afraid. And some of them are saying, I'm going to try to reach the U.S. border again and cross no matter what before Trump gets to the White House. So many of them are going to try to do that. But some of them are, rethinking what they're going to do. Some
Right.
will stay in Mexico, and some are planning to go to different countries.
Alex, what do we know about the source of some of these migrants? Is the flow being impacted by an expectation that Trump will be much more difficult on immigration? Are we seeing some of those flows of migrants north? Are they slowing down, stopping, or staying the same?
I mean, with this crackdown, actually the number of migrants walking through Mexico is slow a little bit. But right now, I think we're going to see, especially the last days of December, we're going to see a surge in migrants trying to cross the border, especially before Trump starts the new government. So obviously, this is related with the conditions in their own countries. We got to remember that Maduro in Venezuela claimed he won an election and the opposition said he didn't. So a lot of Venezuelans are leaving right now, and different hard economic conditions or even drug trafficking in countries like Colombia or Ecuador. So, migration will never stop. But I think in the coming days, we're going to see a lot of more migrants trying to reach the U.S. border for sure before Trump, because he has promised to change or to eliminate these avenues they have right now to enter the U.S. legally.
Yeah, that's what we're also trying to figure out here, Alex, is like, is there going to be a mass roundup of immigrants here in the U.S. that are undocumented? And like, what does that look like? And how does that happen? And then where do they go? Are you guys talking about that part at all?
Yeah, I mean, actually, Mexican President Claudia Sheinbaum had a phone conversation with Trump about that. And the Mexican government is preparing for mass deportation. They're, reaching out to all of their consulate offices in the U.S., trying to get all the personnel ready to support migrants in case of mass deportation. They're getting ready for that scenario. But Mexico has said that they will only receive migrants from Mexico, that they are not willing to take migrants from different countries. So we don't know yet what's going to happen in the case of Venezuelans or Cubans, for example, because the U.S. doesn't have any formal relationship with these countries, so they won't take them.
Right.
So Trump said that this government will have to take them, or he will, impose new sanctions, but we don't know if that's going to happen. So it's going to be messy for sure.
Okay, Alex, thank you so much for joining us. Alex Vasquez, economy and government reporter for Bloomberg News, joining us from our Madrid bureau via Zoom. The latest, the big take story. You can read this, more of this story on the Bloomberg and at Bloomberg.com/big take, talking about the migration situation, which is clearly a fluid situation and will continue to be so under President-elect Trump when he takes office in January. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy post-Fed day. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. You can also check us out on YouTube as well. We have a great hour lined up for you. We're going to tackle what's happening in D.C., whether it's the debt ceiling or the budget or continuing resolution with Nathan Dean of Bloomberg Intelligence in just a few moments. Plus, David Kudla is founder, CEO, and chief investment strategist at Mainstay Capital Management. And Nike reports after the bell, as well as FedEx. We're going to break down what to look at from Nike, macro issues and micro issues for that company. And Michael Shivo is CEO at Shivo, will be joining us on the state of commercial real estate. This conversation might have been very different yesterday at this time, so we'll see what this outlook is into 2025. But let's kick this all off for you right now with Charlie Pellet with a Bloomberg Business Flash.
Hi, thank you very much, Alex Steele. Bounce back Thursday, sort of. We have got the Dow, the S&P, and NASDAQ all advancing. Right now, the S&P is up 28 to 5,900 even. That is a gain of just about 0.5%. Dow Jones Industrial Average also advancing. Now we've got the Dow up 172, a gain of 0.4%. NASDAQ up 107, drop there, a gain there of 0.5%. The Russell 2000 index, though, in the red. Small cap shares moving lower. The 10-year 4.54% a day after the Fed. The 2-year 4.28%. Gold little changed, up 0.1%. 25.87 right now. West Texas Intermediate crude holding above 70 at 70.32 a barrel, down 0.4%. And Bitcoin now at 100,400. Bitcoin down by 0.5%. Frances Donald is chief economist at RBC, and this morning on Bloomberg Surveillance, she talked about the Fed's hawkish pivot.
This is really a Federal Reserve that, even though they say they're not incorporating the effect of Trump policies, or some of them are, but some of them are not, is absolutely internalizing what they expect to come next. It is in their psyche, it is in their biases. They are afraid of inflation. And Powell, while trying to speak out of both sides of his mouth, really gave the impression that the Fed is focused on what those CPI, PCE numbers are going to look like, and therefore that's what the market will be focused on.
Francis Donald of RBC interviewed on Bloomberg Surveillance. And by the way, you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Micron Technology shares plunging, down 17.6% after earnings. Lennar after earnings, down now by just about 5.6%. We'll have more on both companies coming up with our Nora Melinda in just a moment. After the bell, a couple of high-profile earnings. Nike down 0.4%. We'll also be hearing from FedEx, up now by 0.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio. We are streaming live as well. Who isn't streaming these days? We're certainly streaming. So you go over to that YouTube thing and search Bloomberg Podcast, and that's where you find us. As Charlie was just reporting, we got some green on the screen here after yesterday's sell-off. Let's look at some individual names. We can do that with Nora Melinda. She covers all the equity markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Nora, what are you looking at?
Well, let's take a look at Micron Technology. That's ticker MU for those listening. It is one of the worst performing stocks in the S&P 500 today. It's tumbling for its worst day since the pandemic days, down as much as 18%. Now, that's the biggest drop since March of 2020. The company hasn't really been doing so well in recent months. I mean, shares have tumbled almost half since their June peak. But today they're sinking after giving a much weaker than expected forecast. Essentially, the outlook came in lower on demand in its key product categories like smartphones, personal computers, and this all offset the strength that it was seeing in its high bandwidth memory, which is a component that they use in AI computing.
That's just what's so interesting to me when it comes to Micron, though, because the stuff we supposedly care about was good. They just had to push out the recovery for the stuff we knew that was already weak.
Exactly. And, you know, Wall Street can be harsh at times, and this is one of those moments for them.
Ain't that the truth?
Back in the day, I would have been nibbling on this stock today.
Right.
Yeah. I'd be buying a little bit.
I mean, we just talked to Kim
But I'd buy
Morris
a
at
little
Boca
bit here,
Capital Partners.
Then I'd wait. Yep. Well, she's long. She kind of has to defend it. But if this were a new name for me, I'd be like, I'm going to take a little bit of a position here.
Buy that dip, which is exactly what we're seeing overall. Like Citi was even saying, like, buy the dip in the equity market because the goods are going to outset the bads, because that's correct English. All right, let's go to Darden Restaurants. They reported earnings. What's going on there? And also, what did they say about inflation?
So apparently diners are returning for Darden Restaurants, and they are one of the owners, or they are the owner of Olive Garden, rather. They raised their full-year sales outlook and the topped estimates. They're saying that casual diners are apparently eating out more, so we're seeing shares of DRI surging for their best day in more than 4 years. They're up as much as 18%, and this is them having them rally for an all-time high. This is more than a 30% advance from its July low, so high-flying stock right now.
They also, though, talked about inflation, that they thought it came in the back half higher than they thought. So I always love those read-throughs from these companies, because that was sort of the zeitgeist of the Fed conversation as well, that the inflation picture is getting cloudier and cloudier to the upside.
Right. They're saying that demand is expected to return next year after persistent inflation and weak consumer spending hurt the casual dining industry. But they have rolled out a partnership, apparently, for delivery with Uber. That was last quarter. And it ran its never-ending Pasta Bowl promotion at Olive Garden. So that has boosted sales a bit.
Just roll me home after that puppy. All right, and then wrapping up with Lennar.
Yeah, Lennar, I mean, this is a home building stock. We're seeing shares lower as much as 7.4% today. That's the lowest intraday in a year. And this is after its first quarter guidance fell short of analyst expectations, and its full year guidance was lowered. Now, this is all coming after a day after we reported that Lennar has plans to spin off most of its land holdings into a separate publicly traded REIT. But we are seeing more of sell-off when we're looking at home builders more broadly after this news, as people are really adjusting their expectations and outlook for the home building industry moving forward, taking a more cautious stance.
All right, Nora, thanks a lot. Really appreciate it. Nora Melinda joining us, Bloomberg Equities reporter. Really great breakdown of some of the movers there, because earnings, they're still coming. You got FedEx and Nike after the bell today. All right, Nathan Dean was here yesterday, and now he's back in D.C. I can't keep track on that.
He's got the whole Acela thing
going.
Yeah.
All right, Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joins us now from D.C. And we had a totally different conversation yesterday, Nathan, when it came to politics. And then today it's like, oh, wait, maybe there will be a shutdown on Friday. Oh, wait, maybe the debt ceiling is in play now rather than in the summer. What is your take and consensus on what's going to happen?
Yeah, so yesterday I said there was a 20% chance of a government shutdown. I'm only going to go to 40%, so I think I'm out of consensus here. But what I'm saying is that I think we're going to have a 40% chance of a government shutdown by Monday. So tomorrow night, obviously the government shuts down at midnight unless a continuing resolution has been passed. But we've seen in the past before, Congress sometimes takes the weekend to figure out a deal. And I think despite all the bluster and the political posturing you're seeing at the moment, I think a deal can be made for a clean CR plus disaster aid plus potentially the one-year extension of the Farm Bill. Because if something doesn't happen, that Farm Bill and the impact on farmers is going to be substantial in 2025 if the government shuts down. And I think that's going to be what finally gets this deal over the edge. But like you said, the debt ceiling's now involved, and there's going to be a lot more political hiccups to come, certainly over the next few weeks and months.
All right. From my perspective, the politics and the people involved seem a little squirrely to me. I've got a president-elect, and I got some civilian dude really weighing in on this issue in a big way and moving markets. Yet I have a president who's actually sitting in the chair, and I don't hear anything. What's going on in Washington? What are you guys doing down there?
Yeah, so essentially what the Democrats are doing right now is essentially letting the Republicans try and figure out what is the base case scenario. All these negotiations that you may know are taking place in the House with Speaker of the House Mike Johnson. And he was the one that negotiated a deal that Elon Musk and then later President Trump came in and said, no, we're not comfortable with. So what you need right now is the Republicans to come on board with an idea of a bill that will pass the House. And we've even seen Senator Majority Leader Chuck Schumer say, you look, from the Senate perspective, we're just going to let the House figure it out first, and then we'll deal with it. And that's where the debt ceiling eventually comes in because, look, you can't really get a debt ceiling deal, I don't think, within another, like, say, 24 hours. These usually take weeks and months to hash out. And if the Republicans decide to move forward with a 2-year extension of the debt ceiling, more often than not, Republicans also insist on cuts as a result of that. So I think what will happen here is the Democrats sort of way back and they say, okay, Speaker of the House Mike Johnson, you figure it out. You come up with a plan. You get this plan through the House. And then if that's the case, then we'll move forward and we'll deal with it on the Senate side. Because for everything you're talking about, just remember, this has to be bipartisan because you need 7 Democrats. I'm sorry, you're going to need a lot of Democrats to come forth and get this through on the Senate side.
Is the debt ceiling really in play?
You know, obviously, I think President Trump, when he made the statement earlier today that they should abolish the debt ceiling, that's something the Democrats would actually welcome. We saw Senator Elizabeth Warren even say that she would support President Trump on that matter. I think that was also a way for President Trump potentially to give Speaker Johnson a way out, saying, look, if we can't get the debt ceiling done, but from the market perspective, what I would say is the deadline is not December 31st. That's only the date in which Treasury can use extraordinary measures to keep our funding. The actual X date, if you will, is sometime next summer. So from the market perspective, in terms of government shutdowns and debt ceilings and so forth, we're not seeing much impact from all this political posturing at the moment.
What's the feeling in Washington, Nathan, about the status of Speaker Johnson? Because it feels like he's really under the gun here from all sides.
Yeah, you know, if we had this conversation last week, I'd say it's fairly comfortable in terms of his position, but today it's not. Senator Rand Paul even floated the idea of potentially having Elon Musk to be the Speaker of the House, because you don't have to be a member of the House of Representatives to be the Speaker. Now, I don't think that's going to happen, but a lot of the Johnson allies, if you will, have been sort of questioning whether or not he has the chops for the job early next year. And, you know, that election is going to take place on January 3rd. So I'm not exactly sure I'd be comfortable if I was in Speaker Johnson's position. But that being said, I don't know anybody else who wants the job.
Wait, but let's get back to the Elon Musk thing, because I don't think I knew that, but then I think I forgot it, and then now I know it again. So just walk me through. So anyone can be Speaker of the House, like my mom could be Speaker of the House if she gets enough votes?
Yeah, you know, if Paul wants to get back, get into government service, we can have Paul be Speaker of the House. You know, essentially, it's something that goes back to obviously through the Constitution days and so forth. But there's been a lot of talk over the last few years about potentially having President Trump become Speaker of the House during the Biden administration. Obviously, that didn't go anywhere. But the reason why Elon Musk would not want to be Speaker of the House is because, yes, you get to use the bully pulpit and you get to decide what's on the floor, but you also have to get into the nitty-gritty and manage all 220 Republican members next year when you only have a majority of 5. And that is an extremely difficult position when you have to make tough choices like, am I going to shut the government down, or am I going to extend the Farm Bill 1 year and provide all this relief to the American farmer base? That's a tough choice, and that's why I don't think the Elon Musk rumor, if you will, is a serious one.
Okay.
Okay. We're still processing.
We're still processing. I also just feel like, I mean, can you imagine, like, running the house, or being part of SpaceX, running your AI company, running Tesla. And there's a lot going on there. Okay, so give me some. Well, let's go back and talk about playbook. So we have learned what maybe a Trump playbook for 2025 then looks like. Is this what we can start expecting, right? Like the Congress does something, and then Musk, Ramaswamy, and Trump kind of weigh in different ways, and then that affects policy. Is this going to be the state of play?
I think so. I mean, obviously, a lot has to happen, but I think, one of the biggest issues, if you will, is if they pass a continuing resolution that kicks this into March, now you've got a funding fight within the first 100 days of President Trump's presidency. And it's usually when presidents don't want to deal with funding because they want to use their political capital on things like immigration, border, potentially in this case, a reconciliation package for tax extensions. But if this government funding fight kicks the can to March, now you're going to have Elon Musk tweeting out there saying, look, we need to delete the CFPB or get rid of the Department of Education. And at that point, you are going to need 7 Democrats in the Senate to agree. You most likely won't. And now you're going to have a government shutdown. Is that a fight that President Trump wants to have within the first 100 days of his presidency? We really don't know. It just depends on the politics per se. But I will say is that we do think a prolonged shutdown, whether it's in March or September of next year, I would bet on September, a prolonged shutdown of 2 to 3, 4, 5 weeks potentially could happen because right now both parties are saying, look, we're sitting pretty comfortable with the positions that we have.
All right, let's go to what was a front page topic a matter of a week or two ago, which are some of these nominations that have to get Senate confirmation in January. Any update on some of the more contentious ones? Mr. Hegseth, Tulsi Gabbard, RFK Jr., just to name a few?
Yeah, so they're making the rounds on Capitol Hill as we speak. I mean, Senator Fetterman from Pennsylvania met with Pete Hegseth earlier this week. And RFK Jr. is making the rounds today. I would just say that, I think right now and for the rest of December, it's really just going to be more of these like photo meet and greets and so forth like that. We're not seeing a ton of pushback on Pete Hegseth like we saw a week ago, but I think a lot of the fireworks will come down to these committee hearings and obviously these nomination hearings because a lot of the tough questions are going to be asked, and these are going to be asked from both Republicans and Democrats. And so for somebody like Tulsi Gabbard, if a senior Democrat begins to really question on some of those positions, things could potentially unravel. But I will say, remember, the Republicans are going to have 53 in the Senate next year, which means you can afford to lose 4. And so, many of these cases, I think it's going to be pressure for them to withdraw because the votes may be there for them to get across the line.
Amazing. It's going to be fascinating to sort of watch how all of this winds up playing out. We also heard over the we heard it yesterday, we've had about 24 hours to digest, is that the Supreme Court's going to take up that TikTok version. What do we make of that? Like, how do you think that's going to play out in D.C.?
Yeah, so my colleague Matt Shettenelm and I were talking about this yesterday, and I really ranged his head on this. This is a question of, this law was scheduled to go into effect January 19th, one day before the inauguration. And there wasn't really, just remember, we're talking about a law here. And so if you want to undo the law, you either need the courts to come in and say it's unconstitutional, or Congress has to pass a new law. And so there isn't really much of a magic wand that President Trump could do on day one unless the Supreme Court were to give that magic wand to him. He could certainly say to the Department of Justice, yes, you don't have to enforce this. But from the Apple perspective or any other company that offers it on their app store, that's actually not a very comfortable position because you want to essentially be able to say that President Trump can't change his mind 3 months from now, or a new Democratic administration 4 years from now could say to Apple, look, we understand that, you've been operating against the law. Here's a multi-billion-dollar enforcement action for your problem. So the Supreme Court case is going to be extremely key to whether or not Apple gets any of this clarity going forward and what essentially that law entails.
All right, Nathan, thank you so much for joining us. Nathan Dean, he's our go-to person down in Washington, D.C. as it pertains to all that policy stuff there. And I think we're going to be talking a lot to him in the coming days, weeks, and months, and maybe the next 4 years. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. He is based in our Washington, D.C. Bureau. I learned something today. That is, you don't have to be a member of the House of Representatives to be
I think Speaker. I did know that. I remember that Trump rumor.
Yeah.
But with Elon Musk, that feels like, I don't know. It feels heavy.
Yeah, that could be. You learn something every day.
He doesn't sleep now. Imagine what happens.
Yes, exactly.
If that were the case.
Sleeping on the floors.
Did you see the awesome Blackstone holiday video?
I did not.
Okay.
I'll check it out.
So every year Blackstone has a holiday video that comes out. It's really quite funny. I'm in it for a
Really?
moment, 1 minute, 35 seconds.
Wow.
It's obviously all to promote their alternative assets in addition to stocks and bonds and all that kind of stuff, but they do, it's really clever. I don't want to spoil it, but definitely check it out. Anyway, much more coming up. We're going to break down what to expect about Nike earnings. They're after the bell in the hot seat. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks advancing with the S&P 500 index at 5902. S&P right now up 0.5%, advancing after yesterday's 3% rout. The Dow today up 230, up 0.5%. NASDAQ up 0.6%. The NASDAQ 100 index up 0.3, but the Russell 2000 index of small cap shares slumping now by 0.2%. Again, to put it all in context, we got the S&P up by 0.5%. 10-year, day after the Fed